All right, welcome to the Investor Expo show for Thursday, December 19th. Happy holidays to everybody, and I hope it's been a great trading season and holiday season for you so far. I know the holidays are right around the corner, and so we appreciate you taking the time to be with us today. We've got a great lineup here for amazing speakers and traders: Michael Valtos, Chad Searcey, Jane Gallina, and Barry Gaines, and really looking forward to a great show today. If anyone has any questions, feel free to ask them in the box, and we'll go ahead and get started. Our first guest is Michael Valtos. He's a 20-year professional institutional futures trader from the floor in Chicago. Started trading in the CME trading floor and later left the open outcry trading pits and became an electronic trader. Managed futures and massive funds for Commerzbank, Cargill, and most recently 8 years at JP Morgan. This is your chance to learn his order flow concepts, which is a tool that many floor traders used and was very successful on the floor. That's been one of the few keys that was able to get people to transfer from the pits to the screen. Michael brings a unique perspective in order flow analysis and someone who's traded for a living at the highest institutional level for over 20 years. A good friend of mine and a great trader. Welcome to the show, Michael.
Hi, Jack. Thanks for having me. Hello, everybody. Happy end of the year.
Yeah.
It's not just the end of the year; it's the end of the decade. That sort of gets lost in it, and it's always a good time at the end of the year to sort of reflect on, how your year's been. Did you reach your goals of where you want to be? And I think that I sort of look back on my life over the decades, and in the '90s is when I got started basically in the industry, on the floor. Then, in the 2000s, electronic trading was really picking up, and that was sort of like my, the real work time for me. And then in the teens, I guess it is the tens, 2010 to 2020 is, I sort of made the shift out of the institutional trading, started my family, and basically trading for myself, and started order flows. So I'm kind of interested in seeing what the new decade brings, and where I'm going to go from there.
For sure. I know you're, and I don't know if the people know here in the event today, but you have extensive experience. I mean, when it comes to gurus, you have been and seen it all. You've been a floor trader for many years, which I was a floor trader, so I know what that means. And then you successfully made the change from floor trading to the screen, which I know 97% of the people were unable to do that. And you managed massive business, which I know you understate, but managed massive business for huge banks in the futures markets as well. So I want people to understand that Michael is somebody who is an absolute authority figure and has probably traded, I don't even know, billions of dollars total between the banks and everything over time. And what I
Yeah.
really like about your strategy is the order flows because it's close to my heart. I mean, that's when I was on the floor, that's how I traded, and when I left the floor, that's what I was trading as well. So I always enjoy your presentations. One thing I want to talk about today, because I know it's on everybody's mind, is this year. How do you think volatility has played into this year, and what do you expect going into 2020 for volatility and how that's going to impact the market?
Well, it's been an interesting year. Actually, it's been an interesting last couple of years since Trump's been president. And,
Right.
you know, I think next year is going to be more of the same. We just had that impeachment yesterday, and, the market just sort of shrugged it off. It, there's, volatility is nice, but it's a two-way sword. It's nice, you get nice price movements, but at the same time, if you're not careful, it can chop you up. And I don't really foresee the market getting extremely volatile. Honestly, that's my own opinion. I mean, if you just look back over the last year, so much has happened news cycle wise that you think, oh my gosh, this is it, and the market keeps making new highs. So unless there's like some big major catastrophe in the world, I mean, hopefully not. I hopefully there's just going to be more of the same.
Yep, it should be interesting for sure. And one thing that you always talk about is following the paper, following what people don't know what paper is. It's the big banks, the institutional hedge funds, the people that are trading massive funds. What is it, just in a general bird's eye view? What is it about following paper that, in a general sense, makes so much more sense than most strategies?
Well, it's what makes it most important, in my opinion, is it shows real commitment to the market. It's somebody took a position, put their money on the line, and saying, you know what, I think this market is going that way. I'm willing to buy. It's not something where you think, well, I think the market could go here. When you follow the paper, right, when you follow what's actually being traded in the market, it shows you what people are actually doing, right? They're actually committed to the market, to a position. And at some point, they're also going to have to get out either with a profit or with a loss. And it's that commitment, right? Because markets basically, is the group collective psychology or thinking of where the market is, relative to value today, and where they predict it's going to be in the future, and you make a commitment based on that. And it's the way I describe it sometimes for people is, you go to if you're single man, you go to a bar to pick up a girl, and
Right.
you see a pretty girl sitting over there, and you sit there, tell your friends, you're drinking your beer, oh, that girl's so pretty, I'm going to ask her out, but you never do, right? You're not committed to it. But once you get over there, start talking to her, you're committed to that, that, I don't want to say relationship, but you're committed to that action right now. And you know commitment, in my opinion, is more stronger than intent.
Right. For sure. I totally agree, and it makes sense. And a lot of people end up following retail traders, and that just gets them chopped up, or everybody's looking at the same indicators. So I'm excited for your presentation here. I'm going to uh, switch you to an organizer so you can see the questions, and then I'm going to switch the screen over to you. Anyone that has any questions during Michael's presentation, please ask them in the box. There's a question box here on the GoToWebinar control panel. You can type in the questions there, and Michael will either answer during his presentation, or at the end, he and I will talk for about 10 minutes, and I can ask some of the questions that he may not have gotten to. So I'll turn the screen over to you. You'll have about 30 minutes,
Okay.
Michael, and I'll pick you back up after that.
Okay, great. Okay, I should be showing my screen. Everyone should be good to go. Hopefully it's the right screen. Yep.
Mm,
It says it's got a 2020 sign up there for the New Year's.
there it is. I
All
see it.
right.
You're good to go.
Yeah,
All right,
Happy
Michael,
New
take it
Year.
away.
All right. Thanks, Jack. Talk to you in a bit. All right, everyone. Welcome, and happy end of the year. Hopefully this past year has been good to you in the markets. It's been really nice to me, and I'm always happy when you get to the end of the year to look back and sort of take stock over my previous year's trading, areas that I did well in, as well as areas that I think need improvement. And it's not just a new year, it's a new decade. So you really got to be thinking big. And everybody likes to make New Year's resolutions, lose weight, quit smoking, make new friends. But for traders, it should be only one, right? Improve your trading results. And honestly, that's why you're here, right? You want to always improve yourself in life, and especially in trading. And that's why if you stick around to the end of the presentation, I'm going to give you a copy of my book, Trading Order Flow. It's a 150-page book that I wrote, I think around just a few years ago. Now, before we begin, just a brief disclaimer. Do remember trading does involve risk. For some reason, sometimes people have this concept of it's a race. Oh, I got 3 months. I got to become a good trader in 3 months. Trading takes time. For some people, it takes 3 weeks. For other people, it takes 3 months. For other people, it takes 3 years. Just understand that it's not a race against time. It's a race against yourself and what your capacity for learning is. So, as Jack had just mentioned earlier, my name is Michael Valtos. I've basically been involved in the futures industry since the early 90s. I started on the CME floor as a runner for Dean Witter, literally at the bottom of the industry at the time. Eventually, I moved off the floors. Electronic trading was taking off. I stayed with Dean Witter, then left for EDF Man, which is a big English commodity trading firm. Been around since the 1700s. Then I went to work for Commerzbank. I was a licensed Eurex trader. I traded Bunds, Bobble, Schatz, DAX, Euro stocks against the US products. I did that for 3 years. Then I left that to become a trading desk manager at Cargill, where we traded all the commodities around the world, both futures as well as cash markets. After that, I took about 6 months off, traveled a bit, and I joined JP Morgan, where I spent 8 years there as vice president of futures trading. And after the birth of my first child in late December 2012, I decided to leave JP Morgan and started writing my book and trade for myself. Then I started order flows about a year or two after that. Now, order flow is something that I've always been involved, right? As Jack has mentioned, on the trading floor, the open outcry floor, you watch what is going on in the order flow, orders coming in, what's behind it, if there's more buying or more selling, are locals being aggressive and whatnot. And I started writing a book on order flow, and I was using an order flow chart from another company, and it was just a basic chart, which in the early 2012, 2013 time, was good enough. That was a lot of information for new traders to um, to grasp. But I knew that there was more that I wanted to get out of the software, right? I know that software exists to help make your life easier. And, there's ways that I was analyzing the order flow for years that I said, you know what, why don't I just have this stuff programmed? And that's how the order flows trader and orderflows.com was born. And, this is what an order flow chart looks like. And, there's just so much information that the first time you lay eyes on it, you're like confused, your head is spinning, you're going to get a headache. But hopefully by the end of this presentation, you should understand what you're looking at. Now, remember, what I'm presenting is what I built my career on. And hopefully you could find or use things that you can modify and adapt for your own trading. Again, just because I say it doesn't necessarily mean it's true. You have to find the things that I say that make sense to you and adapt them for your trading. Now, just a disclaimer, right? The charts that I use in this presentation are generated from my software, the Order Flows Trader, which runs on NinjaTrader 8. The URL is there, orderflows.com/allin.html. So let's get started, right? How to improve your trading with order flow. Now, when you look at an order flow chart the first time, but most people are by now, it's really getting mainstream that most people are familiar with what they're looking at in order flow. And when you look at it, it's a bit confusing, right? Because you don't really know what to look at. And to be honest, when I started on the CME floor, I was confused as heck. I didn't know where to begin. And, I started as a runner. They said, hey, run this order into the Japanese yen pit. I was like, where the heck is that? Yeah, it takes time to adjust and learn. But one thing I learned pretty quick was if I want to be successful, I had to get over any fears that I had, and I had to learn how to read the market. Now, as we mentioned earlier, right, order flow is two ways. There's two ways to look at order flow, and some people look at depth of market, which is the price ladder. I look at volume footprint chart. And the difference is depth of market is the orders that are sitting in the order book, orders that are not filled. They're getting pulled, they're getting moved higher, lower, closer to the market, further from the market, but they're not traded yet. Now, a volume footprint chart, which I just showed you, is actual orders that have traded. And there is a big difference, right? One shows commitment, one shows intention. In my opinion, commitment is much more important than a trader's intention. And once you have the data, you can put it into an easy to read format and you can understand what's happening in the market. So we know that markets trade in a two-way auction, right? There's a bid price, there's an offer price. And there's a quantity for the bid price, there's a quantity for the offer price. And a trade occurs when someone either sells into the bid or buys from the offer. And the important thing is, when you buy from the offer or you sell into the bid, right, you're being aggressive, right? If you're just sitting on the bid and you're just sitting on the offer, if everybody's on the bid, everybody's on the offer, no trade's going to happen. We're just passively trading. Yeah, I'll pay $5 for something, but the other person is going to sell it at 6. Well, no trade's going to happen. We're both passive. I'm happy to pay 5. You're happy to sell it at 6. One of us has to be aggressive, right? One of us has to either go down to 5 or go up to 6 for to get the trade done. And so there's a difference between types of traders. Most people just think of traders as just traders, but there's passive traders. Those are the traders who buy on the bid or sell on the offer. They wait for the market to come for them. Aggressive traders don't wait for the market to come to them. They trade at the market. They sell into the bid or they buy the offer. Aggressive traders want to get a trade done. So once you understand the differences between the different traders and how they trade against each other, passive buyers versus aggressive sellers, passive sellers against aggressive buyers, then you can start to interpret the footprint chart, right? The order flow. Now, to me, there are three building blocks of order flow footprint chart that you need to know. There's delta, there's imbalance, there's point of control. So the delta is the net difference in the bar between aggressive buyers and aggressive sellers. Okay, if you have positive delta, means you have more aggressive buyers than aggressive sellers. Buyers are in control. If you have negative delta, sellers are in control. You have more aggressive sellers than aggressive buyers, and every bar is going to have a delta. Delta could be any number in the bar. I mean, obviously it's the difference. It could be zero, meaning it was evenly matched. If it's zero, to me, that's just more of a coincidence. It doesn't have any special prediction powers. Now, the next one is imbalances. And it occurs in a two-way auction between the volume traded on the bid versus the volume traded on the offer. And generally, I say generally because there's a ratio people like to look at. If you have more aggressive buyers than sellers by 4-to-1, then you consider that an imbalance, or more aggressive sellers than buyers by 4-to-1, you consider it an imbalance. And you could choose whatever number. If you want just 2-to-1, you can use that. If you want to use 10-to-1, you can use that. But industry standards, most people use 4-to-1. I generally use 4-to-1. Now, you'll see on the bar in the footprint, right, a buying imbalance is blue color, a selling imbalance is red color, and that's important, especially at turning points in the market. If you start seeing aggressive buying in the form of imbalances at a low, then you know that aggressive buyers are stepping up to the market. They think the price is low. If you're at a high and you see selling imbalances, then you know there's aggressive sellers up there at the high, and that's very valuable information, because if you know that, oh, hey, at this low price, aggressive buyers are stepping in, chances are we're not going to go lower, right? We're going to start to rally, just as we'd sell off from a high if you start seeing a flurry of aggressive sellers coming in. Now, the last one is the point of control, and it's simply the level in the bar where the most volume traded, both on the bid and the offer. And there are times where it acts fantastically as supply and demand over the next bar and even bars. So what makes delta, point of control, and imbalances so powerful is they are data points generated by true market activity, right? This is based on the buying and selling occurring in the market. And, there's no weird math involved in it. It's simple arithmetic. For point of control, it's volume traded on the bid plus the volume traded on the offer. You add it up. If it's the most volume, that's your point of control. The delta, you take the aggressive buyers volume against the aggressive seller's volume, and you subtract it. Whichever is the higher number, it tells you if it's positive or negative. So think of it like this, right? Just as in your car you have a speedometer, it tells you how fast you're accelerating or slowing down. Order flow tells you how the market is moving up or moving down. Is there strong aggressive buying? Is there strong aggressive selling? Is it weak aggressive buying? Is it weak aggressive selling? And people always say order flow allows you to see inside the bar, which it does. But honestly, what good is it if you don't know what to look for, right? You have to know what you're looking at to be able to interpret it, right? If we go to the doctor, we have an x-ray done, it's a picture of your inside. I could look at it, I don't know, okay, that's my ribs. I can't tell what I'm looking at, but a doctor could look at it and right away, I say, oh, you got this problem here, right? He knows what to look at. And the same way with a volume footprint chart, with the order flows chart, is once you start to know what to look for, it becomes a lot easier to read. And when they say order flow allows you to see inside the bar, right? When we get to this low down here in this blue box, right? How do you know it's a good buying opportunity? Most traders would wait for this market to rally up a bit before they start thinking that, hey, this market's in a rally. But when you're down here at the low, right? When you have these lows being made, you want to know, is this low going to hold or are we going to go lower? But if you know how to read the order flow, you're going to see by looking at the delta, the point of controls, the imbalances, if this low is going to hold. And I can see down here at this low that the delta is positive. I know I've got net aggressive buying coming in. What does that tell me? It tells me I have buyers that are actively taking over from the sellers. And at a low, that's important because you could have a shift in supply and demand. It could be going from a supply-driven market to all of a sudden a demand-driven market, right? And that's what's going to cause trends to happen, is shifts in supply and demand. The point of controls, I see our point of controls in each bar subsequently getting higher right off the low, the next 3 bars, higher, 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 which tells me, we're sort of finding new value areas to the upside as this market is rallying. That tells me something very important, right? It tells me this, that the initial value at the low is considered low. The next bar, you have a higher value area that's bullish. Then the next bar, even higher. So you got 3 bullish point of controls there. The imbalances, I see right off this low, I see 2 bars with 3 buying imbalances in it, right? That's important information. I know I got positive delta. I know I got buying imbalances in the bar. I know I got point of controls migrating higher. And what happens to the market? It rallies, but I can know this right off the bar, off the low, or the next bar off the low if I'm still not convinced on the low bar. That's what order flow allows you to do. Concentrate by looking at delta, point of controls, imbalances, because oftentimes the market will be revealing itself in one of them or a combination of them, right? It could be in the deltas and imbalances. It could be in point of controls and imbalances. It could be in delta or point of controls, or it could be all 3. Now, this is a mini Dow 5-minute chart, and this is just from what day is 2 days ago. People always ask me, hey, I trade a longer term, can I use order flow? And to be honest, I look at order flow, the longest I look at it is 5 minutes. I don't really go beyond that. I know some people that do keep an eye on a 30-minute chart in the order flow, but really, you're basing your trades on what's happening right now. So if you're looking at a 30-minute chart or a longer or hourly chart, what's happening right now sort of gets lost in the big mix. I said about as long as I'll go is 5 minutes. I tend to stick to range-based charts and a 1-minute chart, and markets like Nasdaq I go down to a 30-minute chart. So we're rallying here in the mini Dow, right? We make this high up here around the 350, 28, 350 area, and then we start to come off, go sideways, and then come off the rest of the day down to 250. So it's about a 100-point move. That's a nice move to have. But you want to look for signs in the order flow that this market is going to be selling off. And when you start looking at the actual volume footprint, what's being traded in the market, it really becomes clear, right? What do you have? You have a new high being made right at the high of the day, and you got negative delta. You've got aggressive selling coming in, okay, which is bearish, and it stays aggressive selling for 1, 2, 3, 4, 5, 6, 7, 8, 9 bars. It's a 5-minute chart. So for an hour, basically at the high of the day, you have aggressive selling. What do you think the market's going to do? Do you think the market's going to rally or it's going to sell off? We have so much aggressive selling, it's weighing on the market. Eventually, the selling is going to overwhelm the buying, right? The buyers can't get it any higher because every time they try to poke it a little bit higher, aggressive selling comes in. Now, I have 2 boxes here. I got the blue box, I've got the red box. The blue box is at your high. You see delta is getting stronger in the negative sense. It goes from 72 at the high, 128, 169. So, aggressive selling is actually getting stronger as you're making that high. That's important information to use as a trader. And then in this red box, you have still negative deltas, also getting stronger, 5, -5, -100, -175. But you also have what I call aligned points of controls. You got 3 bars, a 15-minute period where the point of control is at the same level, right? So I know it's creating value, and then we start trading away from that to the downside. I now have a resistance level generated by market information. And why is that important? Is because market sold off, we rallied back right up to that level, and then the market sold off. Right, this is what it looked like. So you have a chance, at the high based on the order flow with, within 2 to 3 bars off the high to be getting short. And then a few bars later, you have a market generated level that if the market comes back to, it's an area for you to be getting short. Market rallied back there, got within, traded 2 ticks through that level before immediately selling off. right? Imagine, right? You have your high of the day up here at at 350. You have offers in here at 338, 339, 340 for a move down to where you were earlier, at the 230s, 240s, when the cash market opened. So you're risking, 10, 15 ticks max for what? A potential 100-point move down. All right, everyone always talks about you got to have good risk reward ratio. Well, that's how you get it, right? You have these market generated levels that you can hide behind. You know, one of the questions always people have is why does the market sell off from a level, right? It's easy to look at a chart after the fact and say, yeah, I could have seen that market selling off from there. But, as a trader, you want to be knowing as soon as you hit that level, what can the market sell off from there? So this is in the E-minis from yesterday. And you see we had two, like this double top here, we sold off each time, right? The second time, it's maybe a little bit easier for people because they'll say, well, we had a double top, we tested it and then we sold off. But what about the first time? Is there any clues the first time? Well, there was in the order flow, and it was pretty clear, right? You're at your new high of the day. You've got, two bearish points of controls together. My order flows trader software will actually color in a point of control that's considered bearish based on, my analysis. That's why I said, I like to have order flow software that does something besides just put up a plain footprint chart. And, I've got a delta divergence. I have a new high with negative delta. My software will also color in that with a red triangle. And I have a bearish ratio. That's this blue number on top. So I've got a lot of things going on for this market up here at this high telling me this market has a potential to sell off. Next bar, lower, next bar, selling imbalances, stack selling imbalances, but all negative delta, right? So you can see how the first sell-off, right? The first high here, number one, was able to get that sell-off, right? Now, the second time we got up to that high, right? Number two that we tested it, well, we make a new high by, about a point, and then you just go sideways. Well, what's the clue in here that this market is about to sell off? In a sideways market, eventually it's going to come out of the consolidation. It's going to come out of going nowhere. And you want to have signs that you can trade off of. And order flow gives you that sign in the delta, right? You can see the first blue box, you have aggressive selling, right? The negative delta getting stronger. So I know there's at this high, there's sellers in up here, okay? But market doesn't really sell off. I do have some bearish point of controls, but still going sideways. It isn't quite yet making that sell off. Then it looks like potentially we could be going higher, right? I see delta, positive delta getting stronger, 96, 192, 397. I got a bullish prominent point of control. Well, the market doesn't go anywhere. Selling reappears right after this aggressive buying. So what's happening, right? You got to be thinking, as a trader, you have to think. I know most people don't like to think. They want to have everything computerized, but that's what's going to give you an edge is your brain power. And if I see that, okay, aggressive buyers are stepping up, but the market's not going higher, then all of a sudden I see aggressive selling coming in, minus 116, minus 215, minus 298. That overrides what I just thought literally 5 minutes ago in the sense that, well, I think this market's going higher because there's aggressive buying getting stronger. Now I see aggressive selling getting stronger. I'm starting to see selling imbalances, starting to see point of controls go down, lower, lower, lower. We're trading below. We got 1, 2, 3, 4 point of controls all aligned right at the same level. We're trading below that. I know I got a resistance level now forming at 1 3/4. We're trading below that. I got aggressive selling. It's time to be short, right? And you see how the market came off from that area right here, right? We came down from, the 1.5, the 02 area down below 99, right? So that's how order flow can help you see, and it's not it's not rocket science or anything like that. It's just simple analysis, by looking at what's happening in the delta, the point of controls, and the imbalances. Now, everyone likes to see signs in the market. What's happening? Is there a sign here? Is there a sign there? And this was in crude oil, yes, 2 days ago. And on Tuesday, right? So we had our high, came off it, made another test up. Then we came back here, we got a lower high, and then late in the day, you got the big sell-off. And people like to draw trend lines. I used to draw trend lines too, and I used to trade off of them. But when they worked, yeah, I thought they're the greatest things. But oftentimes, I'd have a trend line, and the market would just be hugging it. I'd have a trend line, would break it, but then would just rally back up, break it a little bit, rally back up. I found them kind of unreliable for the most part. And there's so many different ways you could draw levels. Honestly, sometimes you could just draw random levels and trade around them. But most people are going to say, well, this red line is the high of the day. That's my resistance area. Or people will say, well, this green line is, this intermediate, the swing high. That's my resistance area. Um, then people will draw a trend line down, the blue line. Oh, you see, we touched it once, twice, three times. And then people will draw. I got a rising trend line. The orange line going up. There's so many different ways. There's 4 different lines I draw. um, you know, which one, after the fact, it's easy to say, well, yeah, you got to trade the orange one because it sold off. But order flow, if you were watching the order flow, you would know that the 60.88 level is quite important, right? You could see we traded 60.88, it came right back up to that level before we sold off, okay? And if you're watching the actual footprint chart, you could see the volume that went through here at about 129. You had 685, 493, 315 on the bid side, 335, 784, 234. Total volume for this bar is 3,200. You got close to 2,000 lots going through around the 88 level, right? I mean, one tick above, one tick below. Um, and that's important to understand, right? Once you understand your market and what's considered heavy volume, honestly, the heavy volume of the 685 and the 784 is enough information already. But when I look at when it was bid and offered and bid and offered above and below, and I see the volumes, it really jumps out. That's how I know that, hey, this 88 level is being defended. At this level, I got a strong seller or sellers. So if it comes back there, I want to know what's going to happen. It could be a potential shorting opportunity. So I draw my line here at 88, and I see the market comes right back up to that level. That is, at 87, you trade. Look at this volume, 101.96. And granted, this is at 2 in the afternoon, right, where volumes aren't usually that great. 99, 68, 41, 44, 107. I got about 600 contracts going through here at 87. Again, I know this level is being defended. So what are you going to do, right? That's an area that you want to get short. If it starts rallying, okay, that possibly is going to become my support area. But I know that we're coming up from down below. We're trading up into it, so it's my resistance area. I've got sellers reappearing. Great, I could get short. You're getting short. Maybe you're not getting short at 87 or 88. You're getting short at 85. You wait for the market to come off a little bit, 84, 83. And then what happens? You start hanging around going sideways before the big drop down later in the day. Okay, but again, this area right here at 1:30 in the afternoon, it's hidden, right? Unless you're looking at the order flow. So, what do you want to be looking for in the order flow? Well, obviously for buys, you want to have price movement in the direction of your trade, right? If you're buying, if you're getting long, you want to see the bar close up, right? You want a green candle, so to speak, a bar that opens higher than it, or bar that closes higher than it opened. You want to have positive delta. Preferably, you want to be seeing increasing delta over, a few bars. You want to be seeing higher points of control in each bar. Preferably retest the previous bar's point of control. And you want to be seeing buying imbalances appearing. For sells, it's the opposite, right? You want to be seeing price movement in the direction of your trade, right? You want to be seeing red candles, red bars. You want to be seeing negative delta, right? You don't want to be buying in a downward market with negative delta, with red bars, with lower points of controls, right? Because what's going to happen is you're probably just going to get run over. You're going to get stopped out, right? You want to be seeing signs in the order flow that this market could be bottoming if you're looking to buy. or at a high, you're going to be looking for reasons to sell, right? So if you're at your high, all of a sudden you see, you know, a couple red bars, you're seeing aggressive selling, you're seeing the negative deltas coming in, you're seeing negative deltas getting stronger as you're going sideways, but you're seeing lower points of controls in each bar, so you know, the volume at each bar, the value area is getting lower, right? That's bearish. And when you start seeing selling imbalances also, that's bearish, right? So you could feel a bit more confident of selling that high. And you know, when you start to put the building blocks of order flow together, you have something that's going to help you make sense of the market. It's going to go from, you know, this on the left to that on the right, where you're able to put stuff together and find trades. So you know, when you start putting it together, like for example, this was crude oil, right? I know that this is a good selling opportunity right here at, you know, at the 85 area because I got bearish prominent point of controls, right? That's the red point of controls there, purple rather. I know I got weakening delta immediately after that. I got points of controls going down. You know, I know that that's a safe sell for me. You know, for buys, right? Again, you know, I don't always like to buy new highs, even though the market can go higher. I prefer to have reasons to sell at the highs. But when I see things that are very bullish in the order flow, you know, I just go with it. You know, when I see bullish prominent point of controls, that's these blue point of controls down here in the middle, right? Then I see the delta increasing. You know, it's gone 63, 165, 656. You know, as the market moves up to 55, we go up from 55 all the way up to, you know, 77 over the next few bars. I see buying imbalances coming in, right? I see in one bar, you know, I see 3 buying imbalances in itself. The previous bar, I see 2 buying imbalances, you know, the bar here at 801. So it's order flow is telling me, hey, you know what, this market is, you know, it's got more potential to go higher. You know, people always wonder why does this is a so this is a 30-minute chart, right? I just wanted to show you this, show you how people can use 30-minute charts. You know, you see this market pull back late in the day. This is NASDAQ. We pull back to around the 82.97 area. Well, then it rallies back up. Well, why? Because earlier you had this, what we call a thin print, which is like a gap in this big green candle up. And oftentimes you test that area, right? So imagine, you know, you've got a gap in here, right? If you know anything about gap theory, you know, at some point you're looking for the market to retest it and fill it and potentially, you know, continue back in its original direction. And it did later in the day. It got within, you know, a couple of ticks. But hey, you know what? If you're trading micros, those new micro accounts, you know, this is a great way to use order flow is, you know, to look for these areas on longer term charts, you know, that offer low risk buying opportunities, because you'd be buying it somewhere around the gap area. You know, you got to remember, right? If you're trading 40 points higher, trying to pick it to an exact level is sometimes there's luck involved. You could come through it by, you know, a couple of points and then rally back up. So you probably want to scale. That's why I recommend, you know, for a lot of people use the micros because it's easier to scale contracts in to catch the move back up. You know, you're talking in one bar, you know, a 20 point rally off of one bar. Now, you know, another thing order flow gives you, like we were talking about very early in this conversation, is following the paper. So I know, right, this is E-minis, we're at our high of the day. This is a 5-minute chart. And as we get up to the high of the day, I could see the delta very strong, minus 2,000, minus 2,000, minus 1,400. I know there's strong sellers in there, big sellers coming into the market. I know I got selling imbalances. You know, that's the order flow coming into the market telling me, hey, there's aggressive sellers up here. You want to possibly get out of any longs that you're in and seriously think about getting short. And then, you know, the market starts drifting sideways and then starts heading down for the rest of the day. Now, hopefully by now you should be able to see how using the 3 pieces of order flow, delta, point of control, and imbalances can give you great trading opportunities. You just need to know what to look for. And it does help to have software that has the ability to highlight that for you. Again, if you're interested, you go to my website, orderflows.com. You know, I got a lot of great information on there. And honestly, we've only just scratched the surface on how to use order flow. There's so many ways that you can use order flow now. And you know, something people don't realize is now hedge funds are using order flow analysis as well. You know, it's not just, you know, retail traders sitting at home. You know, hedge funds are data mining delta, point of control, imbalances and other aspects of order flow. So, if you're not adapting order flow into your trading, I think you're leaving a lot of um, information on the table that other people are going to use and get an edge over you. So if you're interested, you can get my book. Go to orderflows.com/book.html, and it's going to take you to this page. You have to enter your first and last name and your email address, and you hit submit. Then it'll take you to a page that it'll download for you. So, people always ask me, what was the big turning point in my life? It was a Friday afternoon on the floor. There was about 1 hour left in the day. My boss turned to me and said, Valtos, it's your turn. Meaning get up, start quoting me the market. We're going to start trading. My reply was, what can we start Monday? Because I was sort of I had some fears, honestly. I wanted everything to be perfect before getting started. But in life, you have to take imperfect action, right? You have to be committed to what you're going to do, right? I tell you this because the best way to learn order flow is to just jump in, right? But you should have proper training. Nowadays, there's great training available. In the past, there really wasn't. But more importantly, you got to be committed, right? You're at the altar. Those that are married, sometimes you have fears. Now, I admit sometimes I had my fears too, but I was committed, right? I've now got a beautiful family. I've got 3 kids, and I'm happy. And trading has given me that opportunity, and it can give you that opportunity as well. So, Jack, I'll throw it back to you. See if there's any questions.
Hey, Michael, great presentation. I always love listening to your story and the order flow. If anybody has any questions, feel free to add them in here. I'm gonna read some of them off here. So, does your order flow software for NT8 work with playback connection?
Yes, I forgot. It's what do they call it?
I don't
Market
even know what
replay.
that means.
Yeah.
I'll be honest with you.
Yeah, they call it like market. They call it market replay, so you could watch it. You could speed it up. It's to like 1,000 times as fast. So because you sit in front of the screen, it's like tick by tick.
Oh, right, I got it.
So you can speed it up. Yeah, I think it's called market replay. But yeah, it does. And I know usually the question that follows is, does it work? Does this type of analysis work with forex and stocks? It does with stocks. But it needs to be stocks that are actively traded and have good volume because after all, you're analyzing volume. If you're analyzing, say, penny stocks or not, not highly capitalized stocks, you get these days where there's a lot of volume, and then most days there's market is very quiet and there's little volume, so it's really hard to get a grasp on it. But big stocks like Apple is one that I follow with order flow. It follows order flow nicely. But Forex, you have decentralized exchanges in the sense that the data doesn't come from one exchange the way it does from CME or CBOT or NYMEX. So oftentimes you're getting just a white label from Barclays or Goldman Sachs or JP Morgan, and the data that you're getting comes from a completely different source. So you're sort of trading a different quote than than sort of what's really out there. So you can trade. CME has euro currencies. They've got British pound, Japanese yen. So that there are futures contracts on currencies, which is, for me, make perfect sense.
Right. Gotcha. Okay. So next question here. Somebody's asking. This is Sam is asking. May I know how your advanced course compares to the basics course?
Okay, well, just recently I released an advanced course, and the basic course is for people that are relatively new to order flow, and don't really understand things like absorption or even delta point of controls, things like that. Whereas the advanced course sort of is a step further beyond just the basic stuff, because I realize now, over the last few years, a lot of traders have been turned on to order flow, right? So they really understand the basics, and I wanted something out there that was just a bit more advanced that traders can sort of sink their teeth into, right? They understand the basics. It's like riding a bicycle. Right? You know how to sit on a bicycle, balance, and ride it, but now you want to do the wheelies and stuff, so to speak.
Got it. Got it. Makes sense. So let's see. Last question here says, Can you please explain briefly the significance of min max delta and how it's calculated? But we're
Oh
a little
yeah,
short on time, so let's try to make that one a little quick here.
no,
Thanks.
that's fine. There's delta, there's final delta, there's max delta, there's min delta, and it'll appear on the bottom. And basically, max delta tells you how positive delta was at its highest level in the bar. Min delta tells you how strong negative delta was at a particular point in the bar. And there are times where, the relationship between the two is very important. Like, for example, if you're at your high of the day and you had at one point early in the bar, very strong max delta, it's telling you there's very strong aggressive buying, but the bar closed with negative delta, and you see that it's min delta, we closed somewhere near there, so you know that internally in that bar you had strong aggressive buying, but like here on this chart, the high, we got positive delta 2466, max delta of 3276, min delta of 118. So max delta, the maximum buying in there was 3276. We closed at 2466. Min delta was only 118. But there's times where you see max delta of 3276. Final delta and min delta is probably a big negative number, like minus 2466. So imagine what's going on. It went from positive 3,000 aggressive buyers to negative 2,000 aggressive sellers. So it's actually a swing of 5,000. So that's very important information. That's covered in my courses.
Okay, got it. Also, Donna is saying excellent content. Thank you so much. I agreed on it. It was an amazing presentation. I want to point out here in the chat window, if you go, if you're on your GoToWebinar control panel and you go look at the chat window, you'll see a link, the one that Michael had up on his screen. Here, it's clickable here. You can just click. It's www.orderflows.com/book.html. Simply fill out your information, and you're going to get a free copy of his order book here as well. I highly recommend it. I'm biased, being a floor trader and having been a Chicago trader and worked with so many people that Michael worked with as well. But I love this strategy and love this style of trading, and I think it's amazing. And I've seen so many people be successful at this strategy versus a lot of other strategies that I love it. It's close to my heart. I love what Michael's doing. He's got the right attitude in terms of how he teaches people. He's all about giving back and all about making sure people succeed. So I would strongly recommend clicking that link, orderflows.com/book.html, put in your information and download that free book and get started there with Michael today. So Michael, any last thoughts before you go?
No, just everyone have a great holiday. Enjoy the time off. It's for most people they're on break from work. It's a great chance, spend time with your family, and at nighttime, learn more about the markets. You always want to improve yourself in trading.
For
There's no
sure. Lots of
ceiling.
downtime during the holidays. Lots of downtime people usually have, right? There's only so
Right.
much you can talk to.
Exactly.
All right. Well, have a great holiday and wishing you an amazing and safe New Year and the best for 2020, Michael.
You too, Jack. Thank you.
Thanks for being on the show.
Bye.
All right. Our next presenter is Dr. Chad Searcey. He's the Director of Trading Success at Navigation Trading. Prior to becoming a full-time options trader, he was a teacher, coach, and an elementary school principal. Dr. Searcey is best known for taking complex trading strategies and teaching them in a way that brand new traders can easily grasp. Welcome to the show, Chad.
All right, happy to be here.
For sure. Glad to have you on the show. Let's talk a little bit about your history here for a few minutes before you go into your presentation so that people can learn a little bit about you. I have to know, I've never met anyone that went from an elementary school principal into a trader and then an educator. You got to tell me how that happened.
Yeah, so I spent 21 years in education and last 15 as a principal. And it was probably last spring that a friend of mine kind of did a sales pitch to me and asked me if I'd be interested in helping out with navigation trading, his company. And so it was kind of a situation that I couldn't pass up. And I had served 15 years as a principal, which is a very rewarding profession. And, part of what I did as a principal is helping adults in terms of teaching teachers become better teachers. A lot of it is providing professional development. And so this role as the director of trader success is really similar in that I'm teaching people how to trade. And trading was something I was doing, I had been doing for a couple years prior to making the career change. And so it's really just teaching adults, just more of in a one-on-one setting. And I did that as a principal when I would meet individually with teachers, and we develop professional development plans and set goals for their improvement. And really, this is kind of the same thing. I just don't have all the stress that goes with being a principal. So I literally my stress level went from about 100 to 0. So, but I still get to help people and still get to teach, kind of fill that teaching role that I've had for so long in my career. So that's kind of the story.
It actually makes a lot of sense. I mean, I guess when I initially saw the elementary school teacher, I didn't see how it related, but it makes perfect sense. I guess from my perspective, I have 4 little kids, and 3 of them are still in
Uh-huh.
elementary school. So when I'm going there, it's just mayhem, like insanity.
Yeah.
First of all, I don't even know how you worked in that environment. I mean, and I love kids, and I have 4, and I could not. I would
Yeah.
lose my mind if I worked in that environment.
Yeah. 4 years ago, I opened a brand new elementary school. There was 70 staff, 640 kids. So it was quite the task. I actually prior to that, when I first started 15 years ago, I was an assistant principal where I opened a new middle school. So I had the opportunity to open 2 new schools to the community. So I don't know. I feel like I really put in a lot of time and service to that community, and this was kind of a new venture. And like I said, I'd been trading. I learned to trade through my buddy a couple years prior, so it just felt like a really good time to make the transition.
Very cool. That's great. So, one more question before we get going here. So, in terms of what you do for people and educating them, you're the obviously director of success there. What do you actually do? Do you work with clients one-on-one? And I imagine you'll get into this for your presentation, but what's a brief overview on how you would actually work with the people that are in the room today?
Yeah. So what I do is, we've developed since 2017 is when navigation trading started. We've developed a large community of traders. Now that's really our purpose, and our goal is to really develop the best community of options traders that can help each other, work with each other in terms of making monthly income through options trading. And so part of what I do is a lot of people that are interested in becoming or learning about trading options for income. That's what I do is we set up Zoom calls. And so a lot of what I do on the day-to-day basis would be using Zoom, which allows me, to share a computer screen, much like I'm going to do now, and help people, walk people through the steps that I think they need to take. And I can, speaking from my own personal journey of learning how to trade options, I kind of walk them through strategies and things to do in order to learn how to trade options for income, and then continue to support them down the road. So when we have new members that become members of our community, I'm kind of the go-to person that, we want to have people, we want to have someone that can be there to answer questions, whether that be simple questions or I called my cable company the other day and I couldn't talk to anyone. And it was the nightmare. It's like, can somebody help me? I want to speak to somebody. Well, I'm kind of that link at navigation trading where if somebody has some advanced questions, that I'm someone they can get a hold of, and I can help them work through that process of answering their questions and helping them understand more about trading options for income.
Got it. Great. Well, what I'm going to do now is I'm going to make you an organizer here so that you can view the questions that people may ask during your presentation, and then I'm going to turn the screen over to you. You'll have about 30 minutes to do your presentation, and then at the end, you and I will chat for about 10 minutes. I'll ask questions from the audience that they may have asked during it, and we'll talk about how people can get involved with you. So I'm going to turn the screen over to you now, and I'll make sure that your right screen is showing here, and then you can take it away.
Okay. Can you see my screen now? Does that work?
Got it. It's a navigation trading, how to profit in the bull and bear markets. Perfect.
Okay.
All right. So take it away. I'll be back in about 30 minutes.
Okay. So what I want to talk about today is really one of our strategies that we use. So, this strategy is called our Iron Duck. So the title of my presentation is How to Profit in Bull and Bear Markets with the Iron Duck Options Spread. So there we go. So I kind of talked about who I was, so I'm going to kind of skip through that. So who's navigation trading? So navigation trading, we are a community of traders, and what we do at navigation trading is we offer step-by-step strategy courses for trading options, and these are different strategies. So if you're somebody that has some background knowledge when it comes to options trading, you probably heard terms like iron condor, short strangle, short put vertical, short call vertical, directional trades, straddles, calendar spreads. So that's what we do is we provide courses on how to trade options for income. We don't day trade and things like that. We're more options trading where we have different strategies, and we use these strategies to make monthly income. Also at navigation trading, what we do for our pro members is we send detailed trade alerts. So these are trade alerts that we at navigation trading are taking in our personal accounts. And I think if you were to talk to one of our pro members or some of our pro members, they would tell you that our trade alerts that we send on a weekly basis are really what they really enjoy a lot, or enjoy maybe the most, is because they're getting trade alerts from professional traders, and that gives them confidence to put on trades. And so as they're putting on trades that are from our trade alerts, a lot of new traders are going through our strategy courses and learning how to do all the different strategies that we do. Options trading is not something it's not a get rich quick. It's not a something you can just learn overnight. It takes time. It's a marathon. And what I tell new traders is that this is a life skill. This is something you can do the rest of your life. I left a six-figure income job as a principal to trade options full time. So this is something I can do the rest of my life. And I make my money now off my personal trading. That's where I make the majority of my money. And so this is something you can do all the rest of your life. So it's definitely a life skill, and it takes time to learn. Also, we offer professional coaching. I kind of talked a little bit about that. So that's kind of who we are at Navigation Trading. Our Trade Hacker community is something you can see here. This is a site where all of our pro members belong, and this is where if you become a member of our Trade Hacker community, we have people every day that are posting trade ideas. They're posting questions. At Navigation Trading, we jump in and answer the questions. We also have other members of our community that jump in and answer members' questions. And so that is really what our purpose is to build that strong community of traders amongst each other, so that we can just help each other become better over time and make monthly income. So before I jump into the Iron Duck, which is, again, one of our strategies, I always like to start off with a funny here. So this is our Loser's Guide to Online Trading. Hopefully you cannot relate with this guy. Sometimes I feel like I can definitely relate with this guy. We spend a lot of time in front of our computers. So, but if you can relate with this guy, maybe you need to think a little bit about your trading. But definitely, trading is something that takes a lot of our time, and but it's fun. It's fun to do, and that's why we do it. Okay, so the Iron Duck options spread. This is one of many strategies that we do, but this is one strategy that we created this summer, and we rolled it out to our members in October. Okay, so we created a course. Kind of give you some background. My buddy Steve, who's the CEO of Navigation Trading, he sent me a message in probably like May, and said, hey, Chad, I need to show you this strategy. I've been trading it since last November. I've been killing it. I'm thinking about rolling it out to our community. So he showed it to me. I started doing it, and then all through the summer, and then probably it was in October when we rolled the course out to our members, and it's really becoming one of our go-to strategies. So as a former educator, I have learning objectives was something that, as a teacher, something you always shared with kids, and I would share with adults when I would take them through professional development. So this is kind of like our learning objectives for the day. So how do we structure our trades to make money over 90% of the time? How do we profit whether the market goes up, down, sideways? And how do we use a special tweak so that we eliminate risk to one side? Okay, and so in our traditional iron duck, we have no risk to the upside. So if the symbol we're trading goes on a tear to the upside, we have no risk there. In fact, we're actually making money. Okay, what are some of our symbols that we trade, and how do we make consistent profits using this strategy without any trade adjustments? That's something that I know new traders is often confusing. How do you, because part of trading options for income is when you put on a strategy, some of the strategies, if the trade goes bad on you, which is again just part of trading, that's going to happen, you have to make adjustments. And so this strategy takes the adjustments out. There are no adjustments, so it makes it a lot easier and simpler to understand. And then, how to trade this strategy in a small account, because a lot of our new traders, they often start with small accounts, and this is definitely a strategy you can use for trading in a small account. So before I start off here and dive into the strategy, here's our risk disclosure. We're not financial advisors or brokers, so make sure that when you're trading any money that you trade with is discretionary and that you can afford to use. There's obviously no guarantees, and this presentation is owned by Navigation Trading, so that's our risk disclosure that we obviously always have to give before we start. So how did we start with this? How did we come up with this, or why did we come up with this? Well, as you know, the market often takes the stairs up and the elevator down. So there's a need to have short delta in your portfolio. When you're trading options for income, you got to think globally, like your whole portfolio. It's not just a couple trades. You have a lot of trades going on. So as a portfolio, you want to have some short delta that protects you for those times that the market has big losses. There's days where it can drop, like I said, the market takes the stairs up, the elevator down. So we keep short delta in our portfolio. But the problem is losses can accumulate when the market continues to grind up. The last couple of years, that the market's been on a tear to the upside. So if you have 3 or 4 trades that are short delta trades, meaning trades where you're profiting when the market's going down or that symbol's going down, those losses can really hurt your overall portfolio. So we wanted to create something where that would protect and that would give us a short bias as the market moved higher. What you're seeing here is a simple iron condor. So this is a delta neutral trade, but your portfolio naturally gains that short bias when the market moves higher. So when price here moves higher, okay, for you to make money in this iron condor, you need that price to go down. So we wanted to create something where if that market continued to go higher, we're making profit. And if it does go down, we're making profit too. Okay, so thus the iron duck. So our iron duck solution was this protects us from sharp moves lower. There's no need to roll. We put these trades on, and what we call GTFO, get the funds out. So we're deploying a trade. These are shorter in nature, and when we make money on those, we are getting the funds out, and then we're redeploying the capital. Okay, and again, eliminating risk to one side of the trade. So I talked about that. So we use weekly options when we place these trades. I'm sure if you're somebody that has been trading, you've seen this diagram here. So in our portfolio, we place a lot of our strategies like iron condors, short strangles. We place those trades between 30 to 60 days. We have a lot of those going on, and when we send out our alerts to our pro members, our trading alerts, we're sending out iron condor trades, short strangles, and other trades, and those typically have 30 to 60 days to expiration. And the closer you get to expiration, you get more of that theta decay, so you're making money quicker. Okay, so we use weekly options also because weekly options make up over 30% of all option volume, and we want to profit potentially every week instead of every 30 to 60 days. So these weekly options, they don't replace our monthly income strategies. Like I said, we still have those going on, okay? But we are placing them in addition to our normal our normal strategies that we use. They complement those strategies by just adding additional ways at different price levels and different expiration cycles to make weekly income. All right, so our favorite iron duck symbols that we trade. Our favorites are really SPX, RUT, NDX. These are European style options. We also like to trade some stocks. And so if you have a small account, I mentioned people that have a small account can still trade this iron duck strategy. SPY, DIA, QQQ. These are all these are good symbols to trade if you have a smaller account. So a lot of times our members, when we send out a trade alert in SPX for an iron duck, if they have a small account, they will place the trade in SPY. So that's kind of how you would do that if you were, because SPX takes a lot more buying power, 10 times more buying power than what SPY does. So that's how you do that if you have a smaller account. We also like to trade other stocks, and usually stocks that are roughly 200 or higher in price. We also like to trade upcoming earnings on stocks that are $100 or higher. So not only can you place this just for a regular strategy, but you can also place this during earnings seasons, and we've been doing a lot of those recently. So our European versus American style options, basically what I want you to know here is the reason our favorites are SPX, RUT, and NDX is because those just expire to cash. Excuse me. So there's no chance of getting assigned, and the tax treatment is a lot better in terms of your gains. So those you're getting taxed at 60% of long-term capital gains and 40% short-term, which is your ordinary tax bracket. Again, we still do stocks and ETFs, but those basically the tax treatment on those is 100% getting taxed on short-term capital gains based on that tax bracket. You can get assigned if you there's a chance of that. Overall, it's really not that big of a deal. You still close the trade out the normal way that you would do it. But those are kind of some of our favorite symbols. I do a lot of XPX, and again, probably the tax treatment is really the reason why I do more of those. Again, they all settle to cash, so that's you can just let an SPX expire, and when the time is up for that trade, and it doesn't hurt you at all. So the strategy, I found this cartoon. I ordered an iron condor. I don't know how long ago this was made, but if I was on the phone with this guy here, I would say, no, really, you want an iron duck now, because the iron duck has about a 90% probability of profit. So let's get into the meat and potatoes here. So this is what the trade looks like. So this is Thinkorswim. So if you use Thinkorswim through TD Ameritrade, personally, I use Tastyworks, but Tastyworks and Thinkorswim are two of the brokers that we recommend at Navigation Trading. But this is what it looks like, and here's why we call it an iron duck. So it's really a skewed iron condor. Here you can see this trade has a 91% probability of profit. So here is the beak, what we call the beak of the duck. So when we place this trade, this red red line here is where price is. So if price grinds higher, it's not hurting us. This right here is what we call the duck head, okay? So at expiration, if price were to finish between here and here, we're making max profit. Okay, so that's the duck head, and that's the duck beak. Okay, give you that visual. Okay, so again, it's a broken, skewed iron condor, where regular iron condor is centered when you put it on. So this is uncentered. You can see prices here. Normal iron condor would have equal wings. Again, there's no risk to one side. This is a defined risk trade, so you know how much you can lose when you put it on. It's not like a strangle where it's undefined. This is a defined risk trade, and you can trade this strategy in an IRA. Okay, so when we set this trade up, okay, there's certain criteria we want to look for. And the first is no risk to the upside. We want to be able to make a profit if price were to grind higher. We want to make sure we're looking so that our probability of profit should be at least 85% or higher, okay? And we prefer to ladder these trades at different expirations, anywhere between 1 to 21 days. So like in my personal account, I have, I think, 4 or 5 iron ducks in SPX on right now that vary anywhere from 1 to 21 days to expiration. Okay, so again, this is what it would look like if you're getting ready to place the trade. Okay, again, no risk to the upside. Here is the probability of profit for this trade. This is an SPX trade. Here's the duck head again. Your purple line here is your theoretical P&L line. Okay, so how you would lose money in this trade is if price would move beyond our break even. So this would take, in SPX, this would take a large down movement. And those can happen over time. You look in the last year, you look at how many big down movements we have, you could have a handful of those throughout the year. But again, at navigation trading, we trade options based on probabilities. We can have assumptions what we think the market's going to do, but nobody knows. Nobody can sit there and tell you, I know for a fact this is what's going to happen with a price symbol. Is it's going to go up, down, whatever. We play the probabilities. And so when you trade this over time, we've learned that these probabilities play out. Yes, you'll have some big drops where you'll take losses, but you're going to have more trades that finish anywhere between in this duck head and in the beak than you will have in terms of those large drops. And so again, it's just math, folks. So closing our iron duck, these are our rules for closing it. We exit if the loss reaches 100% of our initial credit. So if it's the max profit is $550, okay, we exit if we get down $550. And so that would happen once it moves past this break even. So if price, again, you get a big down move one day and price is down here and you're down, say, let's just, this actually has on this particular trade, $670 max profit. Okay, so if you get down $670 because price has moved this far down, we're closing out. That's one of our criteria. Okay, again, there's no rolls in this trade. Okay, or we just exit at near expiration or let it expire. So again, if we're anywhere in the duck head, it's max profit as we hit near expiration, or if it's up here in the beak somewhere, then again, we can just let it expire, or we close it out right before expiration and for that beak profit. Okay, again, no adjustments or rolls, which is a beautiful thing. So when we did this strategy, we did a back test, and in terms of back testing, okay, this is something that we use to confirm a strategy. We use it to tweak small aspects of this strategy, and to kind of give us an idea on past performance. Okay, so again, we're all about, at Navigation Trading, we're all about trading based on stats and probabilities. You know, we know option pricing over time and over many occurrences, if you trade over and over, that the math is going to play out. These probabilities we know will play out. It's just math. Sometimes it takes longer than normal, and sometimes there are big moves, but eventually those probabilities play out. You know, we are trading these strategies with real money. This isn't some theoretical backtest that we're doing. You know, we're not cherry picking. We are trading this strategy with our real money. You know, we're not taking a period of time and cherry picking points of time during that, say, 5 years and saying, well, it did great here. You know, this is a strategy that we're doing with our own personal accounts. And so when we do back testing, that's the reason why we're doing it, is to confirm a strategy. And so when I get in, I want to show you this back study we did on the Iron Duck. Okay, and we use eDelta Pro for our back testing. That's the software we use. So this back test we did was over 5 years, from July 31st, 2014 to the 31st, 2019. So we used the symbol SPX, and we did a back test on, again, I told you we like to do these 1 to 21 days. 21 days, 14 days, 10 days, 7 days, and 5 days. And then we also did a back test during the recession, okay, from 2007 to 2009. So these are sequential trades. The criteria is we're putting on sequential trades. So every 21 days, where we put a trade on, and it goes to expiration, or it's exited at 100% of our initial credit, which is what I kind of talked about just a minute ago. So that's kind of the criteria for the back test. Same thing with the rest of the 14 days, 10 days, 7 days, 5 days. These are consecutive trades every 5, 7, 10, and 14 days. Okay, so let's start off by looking at the back test for trades in SPX every 21 days. So the average P&L was $234 per trade. Okay, there were 93 total trades put on over those 5 years. 82 were winners, 11 were losers. The total profit was a little over $21,000, and it took about 2.68% of your capital. This was also based on a $100,000 account. Okay, so you know, you look at that trend line for profits, and that's exactly what you want to see. So again, I talked about, you want to, when you put this on, it's just math, and we're looking for trades that have an 85% or higher probability profit. So this particular 21-day consecutive trades had an 88% probability, or 88% of them were profitable. So that held up to what our probability of profit we're looking for. 14 days, there were 135 total trades. 121 of those were winners, 14 were losers. There you can see the profit loss. So it was a profit of a little over $25,000. 90% of those trades were profitable. The average trade had a profit of $187. 10 days. So again, nice trend line here, 198 total trades. 167 of those were winning trades, 31 were losing trades. Here was the profits. $130 was the average profit per trade. Every 7 days, again, now there's you can see there's more trades going on because it's less time for each trade. 249 total trades, 199 trades were winners, 50 were losing trades. Again, the profit was over $26,000. The average P&L was $107 per trade. Okay, 5 days, every 5 days, we had 121 trades, 100 winners, 21 losses. There's your profit. 122 of those, or $122 was the average profit per trade. Okay, and again, you know, when we first rolled this out, we got the question, what about, you know, this is all great when the markets are grinding higher. You know, so what happens if you have a lot of down movement? So with the recession here, this strategy still proved to be profitable. There were 62 trades during this time here, during these 2 years, 31 winners, 31 losses. The profit was a little over $9,000, and the average profit per trade was $149. So this stands the strategy, the Iron Duck, stands the test of time during a 2-year recession like we had from 2007 to 2009. So this, again, I think gives confidence to people that this strategy is a powerful strategy to trade for weekly profits. So when you think about the strategy and the amount of weekly, and you know, I just showed you the back study. So think about this. You know, we have people say, well, those beat profits aren't very much. You know, you're grinding higher, you're getting beat profits that aren't very much. But when you look at the return on capital, so you know, let's say a trade in SPX, or you could use SPY if it's a smaller account. But let's say a beat profit has 125. You know, in this trade here, the beat profit would be $125. The max profit is $625. Anywhere in this, if it finishes anywhere in this duck head, that's a $625 profit. If it price grinds higher and it finishes in the beak, it's $125. Well, the buying power it takes to, and you can just divide these numbers by 10 if you were to use SPY. But the buying power is $1,875 to put this trade on. Okay, if you would book a beak profit on this, okay, and again, this has 10 days to expiration, that's a 6.7% return on capital in 10 days. So I don't know about you, but I would definitely take almost a 7% return on my investment in 10 days. And if you do this 3 times a month, okay, so that's a return on capital of over 20% in a month's time. You know, that's, again, a great return. If you were to land in the big profit, okay, in those 10 days, that's a 33.3% return in 10 days. So again, if the probability of profit, you know, you've got you're making anywhere from 6.7% to 33.3%, okay, in 10 days. So I think anyone would take those profits, you know, between a 6.7 and 33.3% return in 10 days, every 10 days. I mean, that's something that, you know, when you talk about your return on capital and return for your investment is outstanding. Okay. So that kind of gives you the visual of the profits as well. And again, we're looking, you know, 89% probability of profit. And yeah, there's a 10.8% chance that price would drop all the way down to here. And but again, this is just math, and those probabilities based on the back study that I showed you play out over time. Okay, so again, our method here is that we are at Navigation Trading, we are entering trades anywhere from 1 to 21 days. It's very important to let price move around. One thing I did when I first started trading this strategy this summer was I placed some SPX trades, multiple trades, you know, within a couple days, and so price hadn't moved much. And then there was a couple days where we had some big down moves, so those, that didn't work out well for me because all those trades had similar prices. So I took some losses by doing that. So you want to ladder your trades at different prices. So letting price move around before you place these multiple iron ducks throughout 1 to 21 days. That sequence of entry makes a big difference. So this gives you another visual. So let's say you have 4 trades on, 4 iron ducks on in SPX. Again, this could be any of those symbols I showed. So when you ladder these trades, so if price is here and this trade here has 5 days to expiration, that duck head that I showed you would be anywhere from here. Okay, anywhere. So if price over 5 days were to move down, again, I talked about that short delta bias. Okay, if it were to move down, that's max profit. Okay, if it moves anywhere between here. So you've got a buffer here of down movement that could happen, and you're still making max profit. Okay, now on the trade that if you have a trade on that has 10 days to expiration and prices, again, currently here, price could move all the way down to this line and you're still making max profit. 14 days, price can move all the way down here. 27.25 is that base. That's where that end of that duck head is. Okay, 21 days, price can move all the way down to here. Okay, and if it finishes anywhere between or here and all the way down to here, that's max profit. Okay, and if price were to move higher, you're making that beat profit. So that kind of gives you the visual of why we ladder the trades and the benefit it can provide you by laddering those trades. Okay, so we kind of look at this as our go-to strategy. It's a strong strategy, like Iron Man. We call it the Iron Duck. Okay, so I put this in here because I wanted to share my own personal results. So in October, beginning of October, we rolled out the Iron Duck course that teaches you how to actually place this trade to all our pro members. And so I started keeping track of my personal Iron Duck trades in my personal account. Okay, so this actually is from October 4th to December 17th. Okay, so just a couple of days ago. These are all my closed Iron Duck trades between this period of time. So you can see SPX, again, one of our favorites. I love it. 87 total trades, 86 wins, only 1 loss. And if I would have held on to that 1 loss a little bit longer, I closed it out because it reached that criteria of being down 100% of our initial credit, but the price ended up coming back up that day. But again, I was following our criteria, which is, again, you can't trade with hindsight. But so and this is total profit with all my SPX trades. I've had some smaller trades in SPY, 10 wins, no losses. Again, you can kind of see through these. Amazon is really becoming one of our other go-to symbols to trade because it's very liquid and it works out really well to trade the Iron Duck. Google also is one that I just kind of started trading. I've got a couple that are on right now in Google. Okay, earnings trades. Again, that's something we like to do. If the stock is a more expensive stock above $100 and 20 wins, 3 losses, and you can see overall total profit in my personal account based on all my Iron Duck trades. So again, I mean, if you do the math here, 172 wins, 179. Again, it's just math. I'm guessing that that's probably going to be over 90% probability of profit, or I guess 90% of results in terms of profits. So again, the math is playing out. So that's our Iron Duck strategy. We teach how to place it in the course, along with all of our strategies. We do have if somebody out there is interested in becoming a pro member, receiving our Iron Duck alerts as well as all of our alerts. What's included in our pro membership is courses, all of these spreads. These are all strategies that we use. So if you're somebody that's looking to learn how to trade these strategies, these courses are wonderful. They are broken down into small steps so that they're easy to process. You know, I've got a lot of feedback from our members who've gone through these strategies. They're very easy to understand. You know, this is what they look like on our website, navigationtrading.com. They're broken down where they have drop downs. They're very easy to, and each drop down, the course video plays right there on the homepage, very easy to understand. Also, our navigation alerts, I talked about those. Those go out to our pro members in a text and email. You know, those are trades that we're taking in at Navigation Trading in our personal accounts. So you get these alerts in multiple ways. They're specific on entering trades, exiting trades, and also how to adjust trades if trades go bad, which is just part of options trading. You also get weekly videos that comes out every Friday. That is a recap of all our trade alerts, all our positions. It's a wonderful way to learn if you're a newer trader, and it just gives you an update on all our positions from our trade alerts, because people may have questions like, oh, we're down a couple $100 in this trade. And that weekly video kind of tells you, what we're going to be doing with it. Are we holding on to it? Are we going to be rolling it coming up? So it's a very important learning tool if you're somebody that's learning. Here's what our trade alerts look like. So they come to you in an email looking like this. They also come in a text, and it kind of gives you some comments. For example, new short strangle, 32 days to expiration. It tells you the strikes, the calls, and the puts. And so again, very, very simple to read. Here's an example of closing a trade. This was an opening, this was closing. Those are just examples of what they look like. If rolling a trade, and again, I think this is important because I think what our members really appreciate is that if a trade goes bad, and again, that is going to happen. If you're someone that expects every trade to go perfect, that's just not reality. But we send alerts out on what to do if trades go bad. And this is an example of right here of doing a trade that we did in INTC where we opened it in April and it went bad on us, but we were able to roll and adjust the trade. And again, these are all alerts you would be getting pro members. And once it became profitable, we closed it out. We got all that loss back. So again, important that rolling a trade is something that's you have to be able to know how to do, and we definitely send those alerts out to our members as well. I talked about our trade hacker community. This is where you meet and interact with others. Also, professional coaching. We're offering through our Zoom calls, through the Zoom website. That's how we do. That's how people communicate with me. Offering 3 one-on-one sessions. That's a big value, and this is kind of what market price is for that. But we don't believe in charging a lot for our members. Again, we do this because we want to build the best community of traders there is out there. This comes down to a little bit over $100 a month. So this is a special we're running for anybody that's listening. All you have to do is go to navigationtrading.com/expo. So go ahead and write that down, and if there comes a time that you want to do that, that's there for you. So this is my contact information. You can follow me on Twitter at NT_success. Also feel free to email me at chad@navigationtrading.com. Definitely happy to answer any questions you may have. Just shoot me those emails. So that concludes my presentation. Okay, if there's anybody has any questions.
Hey, Chad, great presentation there. Really, really insightful information and very useful, I'm sure, for a lot of people here. Let's go into the questions here. Somebody's asking if, and these, we only have about 10 minutes here to talk, so we'll try to make them brief, but somebody's asking about like a sample of a new trade. Can you just talk about that briefly?
Yeah, so like what a new trade looks like?
I'm not sure. That's just what they're asking.
Sample of a new trade? Okay, so like our So this would be a sample of an alert that would come out. So in our iron duck strategy that I just presented, it would say new iron duck instead of new short strangle, and it would give you the strikes, the calls and puts to place that trade. So an iron duck is similar to an iron condor, where you're selling and buying calls and selling and buying put. You're selling a call and buying a call, and you're selling and buying a put, like you would. It's just that the wings are they're not equal wings in an iron condor. So that would the new trade alert would look like this, and it would have the all the strikes to sell and buy, calls and
Okay.
puts.
Great. And so what I want to encourage everyone to do, I know Chad went over it here, but I want to encourage everyone, if you go to the chat window, and Anna has put the link, the navigationtrading.com/expo, along with Chad's information. I want everybody to click that link and let's go to this page and we can discuss a little bit on this page here. What I see on the page is it's really detailed on what's included in this membership, including the alerts and the VIP course training, hacker community, professional personal coaching, all the indicator packages and watch list and ebook. I want everybody to go and click on that link right now and go there. And I want to talk about this page a little bit here. So I want to just get sort of like a 30-second brief overview on these. Can you talk a little bit about the video course training, the VIP one?
Yeah, so the video course training, we go back to that. So the video course training has all of these courses. These are strategies that we use in our overall portfolio. And so each course, I know it's probably kind of blurry there, but so each one is a drop down. So iron condor, short strangles, the iron duck. We also play strategies like double calendars for weekly income, and that's all. So basically, the course, as you can see, this drop down here is one. I know it's blurry, you can't see which one it is, but my point is, each one of those you click on, it plays a short video, so you're able to, part of when I was an educator, one thing that I always told my teachers is everybody learns at different rates and different speeds. Okay, some people pick up things quickly, some people it takes more time. So these courses are really easy to understand because they're broken down into short segments, and it enables you to process the information. When I started like 3 years ago, I went through these courses, and some of them I had to watch twice, but they were short, anywhere from 2 or 3 minutes to maybe 10 or 15 minutes. So you're able to kind of go at your own speed when you're learning about the strategy that's in each course.
Got it. Great. And so why don't you just walk us through one example? This is a good way for people to really understand it. And I know you touched on this in the presentation, but why don't you pick somebody who you've seen come in that wasn't a successful trader, has gone through the course, and talk about their case study and how they used your tools to become successful.
Yeah, so we often get people that send us emails regarding their profits, and that's absolutely awesome. We love when people share. We also have in our community now. If I pull up something on the internet, can they see it?
Yes.
Okay, so let me go to our trade hacker community here. So our trade hacker community, this is where we get people in here all the time that share, their results with us. And so, part of learning is newer traders get on here and they go through our courses, and then they're also able to post in here, post questions. Like here's somebody, it looks like just 14 minutes ago, posting questions, and then Steve, our CEO, he's jumping right in and answering questions. So this trade hacker community is really what we want. It's really what we want to develop. That's like a community of traders is very powerful in terms of supporting each other. Again, here's what I'm looking at. This is Steve, KMX. This is an iron duck for, I believe this was for earnings. So, and shared in the community. Let me go to the courses, kind of show you those. So again, here's our site. You can look at our performance. We share all of our trade. We share all of our results from all our closed trades. You know, these are all the strategies we closed in November. But what I want to show you is the courses again. You probably get a better look at it this way. This is kind of what I do with a Zoom call too, is I share like this and I go through things and help people understand. So here's all our courses. We've got our alerts. You can also find them here. Okay. So again, we did, this is one that was sent out today, a new weekly double calendar. So if I wanted to learn the double calendar, it's right here with our trading options for weekly income. So this is our course, weekly income double calendar. I click on this and the video here walks you through how to do it. Okay. Iron condors, again, walks you through how to do it. Very, setting up the trade, part 1. So you can see the video is a short video. Part 2, okay, part 3. So you're able to process these and learn these strategies, and they're not overwhelming. There's different examples, trade examples, gold, SPX, to give you, showing you how to do it, adjusting the trade. This is so important to know how to do this. If a trade goes bad, what are you going to do to adjust it to get your profits back or get your losses back? So again, that's kind of what it looks like in terms of, again, these are short strangles, calendars, butterflies, our directional trading that we do, short call verticals, short put verticals. Here is the, let me go down below. Here's the iron duck that it tells you exactly how to set the trade up. I know I didn't have time to go through that, and people are probably wondering, how do I place an iron duck? Okay, I know it's like an iron condor where there's 4 strikes, 2 calls, 2 puts. But how do I do it? This walks you through it right here. So is that kind of, hopefully that
For sure. Yeah, that's for sure.
helps.
That's super helpful. I think there's just so much in this program that you have that to really get a handle on it. I think people need to, at minimum, if they're not ready to sign up today, is at least contact you in the email. I think there's just so much to go through. A lot of the things that we see are pretty simple or basic, but I feel like what you guys have is just such an intense community, and there's so much information and content in there that I would encourage everybody to reach out to Chad by email. I'm sure there's somebody on the team that can kind of go through and help people understand what they can get on it.
Yeah.
And of course, today there's a huge special for the InvestorExpos crowd, everybody that's here in the room. So I want to encourage everybody to take advantage of that instead of waiting and getting the regular retail price. But at minimum, the start is, look, if you're ready to go now, then you can sign up right now and pay. But if you're not, then I would encourage you to email Chad and at least get a walkthrough here and get an idea of
and that's my purpose, is so I can walk you through where to start. You just mentioned there's a lot, and that there's a lot
so
to options
much,
trading.
like a crazy amount.
Yeah, it's a life skill. So part of what I do is break it down for people to say, okay, give me your background knowledge, and then I'll help set up a plan for you. Where do I start? And then I walk you through that. What a lot of people can do too is on our website here. I think if you go down towards the bottom, here, schedule your call. You can click on this, and it takes you to my schedule, and you can pick days and time that we can book a time to talk.
Perfect. That's great. So we're out of time here, and I do want to encourage everybody, again, click the link or contact Chad. I want to thank you for being on here. It's a great presentation. It's been amazing to learn about your history and what you're doing at the navigation trading. And I wish you a great holiday and a very successful and prosperous new year.
Hey, thank you. Thanks for having me, and thanks to everyone. Everybody have a great holidays. And again, we're here to help, so don't hesitate to reach out.
Thanks, Chad. Have a great one.
Okay, bye-bye.
All right, it's been a great show so far. Two really, really good presenters, lots of great information, lots of good content, lots of good opportunity for people that are here to get involved. Again, if anybody has questions during this presentation, they can just ask them, and we'll make sure that we're getting these experts to answer the questions for you. But really interesting to see what Chad's got with it's just a massive amount of information and content and support there in his platform. So let's move on to our next presenter here. Our next presenter. Jane Gallina. She's also known as Airplane Jane. She came out of nowhere to take the testosterone-dominated community of day trading by storm. After completing a Series 7 license in 2001, Jane worked as a sales assistant in a financial community. As a loving wife and mother, Jane wanted to find a new way to take control of her financial future while being there for her family. Welcome to the show, Jane.
Thank you, Jack. Thank you so much. And welcome to everybody. Thank you guys for attending today. And thank you guys for having me back on again. This is a treasure to be able to share with everybody and help. It's like Chad was saying, you know, a lot of people in the industry do want to help others see that they can succeed in trading and do it in a profitable way.
Well said, for sure. It's great that you're on video too. I know that everybody wants the opportunity to be able to get to know somebody. I mean, a lot of this industry isn't just buying indicators in education. It's really buying into a person that's going to be the mentor. I mean, I've always said that in my history, starting on the floor. I mean, if I didn't have mentors, I don't know where I would have been. So having mentors is one of the key things, and it's always great for people to be able to see you and establish some connection, understand who you are before they actually start working with you. So let's talk a little bit about you. So you were already in the financial space, right? You passed your Series 7 a long, long time ago. And
Yep.
how did you make the jump to say, you know what, I'm going to start training people. I'm going to start educating people. What was the turning point that made you take that next step?
What really happened for me was I was in the industry back in 2000, 2001. And then I saw devastation happen with WorldCom. I was in that office in Atlanta with Smith Barney, and I saw that people had taken out margin against their options, but they never went ahead and exercised those options. And then the stock dropped. So it ended up being awful for those people because it was like being in a low float runner, right? You can see them go to the moon and then all of a sudden you see it drop. Well, that's what had happened, and they'd taken money out against their options that they never exercised on margin, and they ended up losing, you know, their houses. Some people, they ended up losing their children's college funds, their retirement money. And so at that point in time, I said, you know what? I don't want to work with other people's money. I want to go ahead and follow my passion for culinary school in Europe. So that's what I did.
Oh, wow.
And then I ended up moving back to Philadelphia, and I met my husband, he was originally from Montreal, and I immigrated up to Canada. And I didn't have a job up here per se. I mean, I had a job in the airline industry where I was just doing customer service, and I kept it as once I crossed the border. But then I found myself married, living in Canada, and pregnant. And at 8 months, they had a reduction of workforce. So I was now 8 months pregnant and laid off. So what was I going to do? And my husband had reminded me of a great trade where I took 25,000 and turned it into 250,000. So he said, hey, maybe you look at day trading. And I thought, hey, that's not a bad idea. Why don't I go ahead and do that? So I went ahead and I started doing research, and I started with penny stocks, and it didn't really work that well for me. I found a lot of the foundation, but that strategy did not work for me. And I'm always trying to tell everybody, you know, there's 101, you know, thousands of ways to make money in the market. The basics are all the same, you know, buy low, sell high, or sell high, buy low. Or if you're doing options, you know, there's 1,001 different option strategies as well. But really, you have to figure out and determine what's going to work for you. So what works for one person might be absolutely amazing, but it might not work for you because you might not have that time to devote to the market. You might not have that risk that you can devote to a really high risk strategy, or momentum trades that tend to be, you know, used on hotkeys. Or it might be that you might not have the capital for a large trade with large amounts of money with equities. So maybe options are better. And you might not be able to watch the market, in the morning for the entire morning. You might only be able to do swing trading and find a strategy that works in the afternoon. So it's a matter of figuring out what really works for you as an individual, because it's going to be you in the market, and the market will show you your flaws. And so you need to be prepared and figure out what works for you, and try to work with someone that's going to work with the strategy that you would like to do. That was a long-winded path to how I came, but slowly but surely I really started sharing on social media, and then on my blog, my book, and even a seminar. And that led me to, actually, I'm working in the training pit now as an educator and absolutely love it. There's nothing better than being able to give back to the trading community and help other people and hear other success stories. It's just the best thing when you get somebody writing you and saying, thank you so much, you know, this has changed my life for positive, like Chad was saying.
For sure. That's amazing. And so let me ask you a question on your overall opinion on the market. So in 2019, obviously, we had some serious volatility here and there. How did the volatility in 2019 affect the way that you traded, and what do you expect in 2020?
Well, something that I discovered back in 2018, really at my first Modern Trader Summit, was Stephanie Camerman with the dark pool, and really following the volume and following the dark pool volume. So tracking where the trades are and seeing how that's going to affect the price of the stock. Where are they going to go ahead and take it? So it's not so much like, where do I think necessarily the market's going to go? I'm going to say, I'm going to follow the dark pools and figure out where to go with them, because right now we're starting to see indications that we might have a massive rip on the market right now, when everybody's saying, oh no, there's so much going on with the debt ceiling, we're going to go down, we're going to go down. And when everybody's totally pessimistic, that's when they're buying into all the short sellers, and they're just squeezing them, and they're just squeezing them. They're like, thank you so much, we're going to go ahead and take it up higher before you guys sell it off anymore, or you know, we're going to take it higher, so that then once you're feeling that max pain, we're going to go ahead and we're going to sell into you, and we're going to determine the top.
Got it. Makes perfect sense. Well, great. Well, let's go ahead and get into your presentation. What I'm going to do first, I'm going to make you an organizer here so that you can view the questions. If anybody has questions, I do encourage you to ask them during the presentation, and either Jane will answer them during the presentation or at the end. Jane and I will talk for 10 minutes anyway, or we'll discuss a little bit more about what she's talked about and how to get involved with her program. So I'm going to go ahead and make you presenter now, Jane, and
Awesome.
you have about 30 minutes. And then
Awesome.
I'll be back with you after that. I'll just stand to make sure your screen shares properly.
Okay, let me go ahead and show screen. I just see myself.
There it is. Nope, I see it. The power of importance and volume.
Oh, yeah, you see it? Okay, perfect.
We're good.
All
All
right.
right, take it away, Jane.
All right, thank you so much, Jack. All right, well, welcome to everybody. If you guys have any questions at any point in time, please feel free to go ahead and pop them in. Happy to help answer them along the way. I can even pull up charts at the same time if you'd like to see them. So the power and importance of volume. First off, we will start, let me go ahead and get to, there we go, the legal disclaimer, right? So all this is provided for educational purposes. Any ideas and strategies that you see should definitely be paper tested first. You know, if you are trying to learn a new strategy, it's really important to go ahead and become consistent on paper before you move into your real money, because that's going to determine whether or not you're going to be profitable, right? If you can't even do it on paper, then more than likely it's not going to be as profitable with your real money. So go ahead and get that practice done with the fake monopoly money, especially if you're learning something new. Like if you're going into options for the first time, do it on paper. If you are going into a new strategy, try it on paper. Prove to yourself that it's going to work before you go ahead and move into it full force. And also know that there are varying degrees of risk in all sorts of trading instruments, so be aware of that. All right, so a little bit more about myself. We talked about it before, but I did get my first experience with trading with my parents around the breakfast table. They were reading the Wall Street Journal, you know, when it was all print. I know they still have it print, but much more digital now. And then I did go and work at Smith Barney, and then came back to the trading world back, goodness, now 2015. So 4 years ago now that my, well, 5 years ago now that my daughter is 5 years old. And you can also see me anywhere on social media. I'm all over the place. I'm on StockTwits. I actually have to change that. It's no longer at Jane at YUL. It's Airplane Jane. So let me just put that down here. So it's at It's Airplane on Twitter, because I had too many people trying to scam other people with my name and my picture, and I really hate that. So I just went ahead and like, it's Airplane Jane. Also on Instagram, on YouTube, LinkedIn, everywhere I can try to help other people, that's what I've done. And if you guys need to email me, you can email me at jane@thedarkpools.com. Always accessible and easy to reach and happy to help. So we'll get into the basic economics, right? So we have basic supply and demand. When we're teaching, we try not to overestimate anybody that's listening or participating, because if you don't understand the basics first, it's really hard to advance forward from there. So basics for supply and demand, right? We think if the supply is really high and there's no demand, the price is going to be low. So say you want to sell your house and there's 10 houses for sale, but there's only one buyer, right? Well, then what's going to probably happen to the prices of those houses? You're probably going to see that they're going to be dropping, because there's not that many people to buy those houses, right? So in order for those sellers to be able to sell, then they're going to have a hard time and they're probably not going to get what they want. Same thing in stocks. When you have a large number of sellers, then there's not as many buyers. That's going to go ahead and determine the price, and it's going to drop it down, right? Vice versa. If you have a lot of buyers, they're interested, there's a lot of demand, but there's not a lot of supply, then that price is going to go ahead and go up. So flip side, let's go ahead and do it the reverse, right? So you have one house for sale, but you have 10 buyers. What do you guys think is going to happen? More than likely, you're going to start to see a bidding war. That price is going to go up, and it's going to go up, and it's going to go up. Same scenario when you're dealing with stocks, right? So you're going to see that that volume is really going to be a determining factor for the price action. Is that volume buying volume, or is that volume selling volume? Really, it's going to come down to that, and where is that battle going to go? So many times people don't necessarily look at the volume candlesticks that are being printed, but it's very important to determine where it's going to go, because that volume is actually driving the price action. So something else that's also very important that not everybody is aware of is the amount of shares that are out there for a stock. So say you want to go ahead and invest in Tesla. Been watching Tesla a lot today, part of their presentation later. Tesla has 133 million shares in the stock, right? And how many of those are going to be insiders? The insiders are going to be the people that own the stock, such as Elon Musk, any of the C-suite members, anybody in the company really that's trading the stock needs to be considered part of the insiders that's trading it, and they always have to file the Form 4s. What's interesting, when you look at the shares outstanding, right? So you have your shares outstanding, and that's insiders held plus the public float, right? So say overall on the initial IPO for Tesla, there was 200 million. I'm sorry, I didn't look up the facts on that one, but I do know it is the public float is 133 million. So that would leave roughly 110 million for this example that's held by the insiders. Now, if you start to see Form 4s coming out that Elon Musk is selling off shares, you know, you could be selling off shares for 1,000,001 reasons, right? You could be getting a divorce, you could be moving the investment into something different. You could be putting a child through college. You could be he could be buying his wife or girlfriend an expensive gift. You never know what's going on when somebody's selling. However, when you start to see Form 4s for people that are buying, that is very important, because many times if an insider is buying those internal shares, they have that inside information. And that's important to watch, because you're going to be able to say, they're buying it, they're expecting this to go up, right? That's a value scenario where they're thinking longer term, I'm going to put my money here as an investment because I know what's going on with the company. So it's something important to see. When you're watching Form 4s, you have to remember that selling can happen for any reason. But if you go ahead and you see a Form 4 buying, especially if it's a CFO, then they pretty much, or a COO, they know what's going on with the company. All right. And you also want to be aware, like I was talking about the float, right? You want to be aware that if a stock is a lower float, then that one is going to move much more quickly. Just going back to that basic supply and demand scenario, if you have a stock that has less than 20 million or 22 million, as this example, for Beyond, and you start to see that there's a massive volume that comes into it. For this example, I used 1 million print for Beyond Meat. That is 4% of the overall public float. So that's going to have more of an influence to the direction of the stock versus a 1 million print on GE, which is going to be 0.1% of the overall public float. They're both going to move the stock because it's going to be a large position, but you're going to see that that one that's on a lower float stock is going to go ahead and move it more quickly. Another way, here's the two different stock charts just to show you that it took, in the same time frame with a 1 million print, it grew, the Beyond the Meat grew 228%, whereas GE dropped 19%. And another way to envision the different floats of a low float or a large float stock is if you look at a train, right? If you think of a commuter train, you're going to be able to say, okay, this is a really fast train. It doesn't have many cars. It's able to go pretty quickly, right? Because there's not a lot of resistance with it. And so it's going to go ahead and move at a faster pace. Now, low float stock can move at a faster pace, both up and down. So they are more risky. A larger float stock is going to be like a big, long freight train, right? That's going to have lots of cars to it, lots of weight. It's not going to be able to move that quickly going around curves. So it's going to be, more resistance in moving that stock. It can still move. It can still have the big gap up days, but it's not going to have the same movement that you will have on a lower float stock of that range necessarily throughout the day. One most recently, LMPX, that one had amazing movement recently. I think it went from, let me pull it up here on my other chart. It went from IPO price on the 5th of December of $5 all the way up to $44. So that's $39. And that took 7 trading days for it to go from 5 to 44. And as quickly as it went up, now it's back down at $20. So you can see that they do move very quickly. However, sometimes that speed can be, if you're on the wrong side of it, you want to get out because that can hurt you very quickly as well. You guys have any questions along the way? All right, so this is also something very important to look at if you are looking at a stock, and I have Tesla here because Tesla is breaking out, setting all-time highs right now, right? So we have people, if you hear people talking about short float versus short volume, to me the short float is outdated, right? That's stuff that's been settled 2 weeks earlier than it's reported to the exchanges. So it's really not that current. And now that we're trading on the internet, everything is at our fingertips. Short float is more outdated to me because it's old news, right? It's not fake news, but it's old news. And so you really want to see what's current, what's the most up-to-date information. And I use the short volume for that. There are 2 sites that I use. I'll type them in here. So I go to volumebot.com and also shortvolumes.com. And those are both free sites that you can get this information. And I have the chart right here from Tesla. And you can see this is over the past 20 trading days, right? So over the past 20 trading days, here's the 50% mark. Over the past 20 trading days, there has been more short volume than there has volume going long. So you can see the actual statistics right here. The last 5 days, the average short percentage was 59%. Then short volume percentage, 10 days, 58%. So people have been adding and adding to their short positions, it looks like. It doesn't look like they're going to go ahead and close it out now that we're at new highs. And you can even see yesterday's short volume, we were at 60%. Is it any wonder that Tesla is up $8 today? It went all the way up to $11 up today. It's pulled back a little bit. But you can see that the market's going to stay irrational longer than people can stay solvent. So when I was talking to Jack earlier, that we see that all this volume is coming in, that it's, whoop, I don't know why that came up. It's important to know that all of this is going on, and not only, you want to see the big picture, right? Whenever you're in a trade, you want to look back, you want to see all the data as much as possible so you can make that educated decision getting in. Yes, Tesla was already up today. However, was there a large number of shorts that were held overnight? What was the total volume that was traded before even coming to market? I believe it was something like 126,000. I could look back really quickly and see, but you can see that 126,000 out of 5 million short yesterday, that's nothing. And now we've traded 12.25 million, right? So if we add this up, we'll say 5.3, 3.2, or that's at 8.5. So we go back to the 16th, that's 14 plus million. There's still at least 2 million, even if all of the volume today was still short volume, right? So looking at statistics like this can help you also make an educated decision. Yes, Tesla had already gapped up. However, it had massive moves. There was another one. I will also be on Traders TV Live tomorrow. Last time I was on, I've mentioned Dick's Sporting Goods. And Dick's Sporting Goods was amazing. It's low float. It had massive short volume. It gapped up on earnings, and it just continued to run. Same thing happened. I don't remember what the other one was, but in the event. Hi, Larry. Good afternoon. So it's really important to get all of that information before you get into it and understand where the volume is coming from. Let me go ahead. I clicked over here, so I need to click this. So you want to understand how the short squeezes can happen, because you never want to be on a scenario like KBio or Elfin, or be short LMPX and have it go. I mean, could you imagine if you'd shorted it that first day at $5 and it went up to 44 and you shorted 1,000 shares? That's a massive, $39,000 against you in 7 trading days. That's pretty painful, right? And it could still be up against you. So you want to know that the short squeeze can really happen when those shorts get really stubborn, right? And that's one of the biggest things in trading, is you don't want to be stubborn when you're on the wrong side of the trade. You want to be able to get out and have that capital available for another trade and turn it into something profitable. And when you're with a low float, you really want to be cautious, because if you're on the wrong side, you don't want to be caught there, right? It can really, really hurt you. I mean, look at Tilray here. We had it back here. This was September, and it went from 80 and then it went up to $300. So yes, amazing for these people that bought here, not so amazing for the shorts, that then they got squeezed all the way up, and as quickly as it went to 300, it took 3 days for it to go to 100, right? So you always want to be very cautious about that. I did mention that I do work with Stephanie, and I'm in the training pit, and we track the dark pool activity. Now, I'm not sure if you know what the dark pool is. The dark pool was established back in the 1980s, and it was established as a location for large institutions to be able to go ahead and get better fills, and they also had lower commissions. So now that's not so much an issue, but if you were going ahead and you're trading, say, 370,000 shares, and for argument's sake, let's say that it was a penny each share, right? You're looking still at $3,700 for the trade. Granted, if you have that money to go ahead and trade 370,000 shares, it's still a small percentage, but it's going to go ahead and it's going to add up over time, right? And that's one of the beauties of right now, is that commissions have taken that cost structure out of a trade, which is beautiful for risk management. So it's easier to practice even with one share of a live stock, you know, if you wanted to really get that emotional experience. And so we track what the dark pool is doing and when the prints are coming in. I eliminated all of the opening prints, and we don't have any of the closing prints here. So these are just going to be the prints that come in throughout the day, and you can see we have them going all the way back from September 13th. And you can see we've started to have big activity, right? 280,000 2 days ago at 379. Is there any wonder that we're up above 400, right? So what do you think the dark pool is doing here? And then also 379 on the 16th, twice, right? 250 here. So we have 500,000 shares of Tesla at 379. That's a pretty nice gain for these guys, right? They've taken 500,000 shares and wrote it $21, right? $10 million, right? It's not bad. So following the dark pool, you can say, okay, look, we had 150, that's 600,000, 280 here, 880,000 shares from the 16th to the 17th on Tesla. Now, that's not small, right? We also just had a major one come in on Yandex today. And seeing all of this happen, it's really important to be aware not only of just the volume on the chart, but then, hey, let me go ahead, let me try to map out a trade with what's going on here, because we see these sorts of things every single day and we keep track of it, right? So we are following the guys that have billions of dollars, like selling or buying 12 million shares on the SPY. We saw that happen this week, right? So we know the price at which they're laying their position. Where are they going to take it? Right now, we're above that, right? We're hitting all-time highs. How could we not be above it? But we get to see a little bit of what they're showing. And that's really what we try to help and educate people with in the training pit, is teaching them that edge of seeing what the big guys are doing so that you can profit just like them. They're not looking for chump change, right? $21 on Tesla is not a small move. We had it happen on Kroger. We had it happen on gold. We're seeing them position themselves again on gold. We saw them take 3 months. Last time I was speaking on InvestorExpos, that it was 3 months that it took them to lay their position in gold. And then we had a massive move in the whole sector. And it wasn't just on one stock, it was on many within the sector. And so being able to see this and being able to understand it and trade it with a huge edge, because these guys are making massive boatloads of money. And so if you can follow them, we've even cracked some of the codes in the Java pit, you know, but really the training pit is where we really help people learn from very, very basics. Like I said, we don't take anything for granted. We have some people that come in and they've never even traded a stock before. So we don't want to take anything for granted, but we take it all in progress, right? And help people all along the way. And being able to see, look, let me go ahead and bring the chart up. You can see we had prints right here. We had prints all along here. So sometimes it will take, let me go back 1 second. It was September 13th until October 17th, or right here. We had one on the 17th too. But that's really where it took them a good month, right, to go ahead and lay their position. And then once it moved up, you have all of this at your back, right? We had more prints here, 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 here. We even had more in December that I showed you guys, 880, right? You see, it shows on the 16th, but they might have even printed them 24 hours late. So we're able to see all of this happening. And is it any wonder, really, that we're going ahead and we're breaking out to absolute highs? When you start to see all this volume behind, Tesla was one of the highest shorted stocks out there. And do you think that they had that information at their fingertips? Do you think that they knew that if they were buying against those shorts, they were going to squeeze them and squeeze them and squeeze them? You know, back here was when Tesla was going to start to get margin calls, right? Because he'd leveraged so much of the Tesla stock for SpaceX, and he had bailed out SolarEdge, I believe was the name of the company. that he'd bailed out with Tesla stock. So he had a lot of debt that he'd built up. And of course, he figured out he'd had his capabilities to stop tweeting. But then you know what happened right here? He figured out he could leak employee emails. So all of a sudden, employee email gets leaked. Employee email gets leaked. You know, oh, employee email, better than usual expected production. We've had higher numbers. And now that we're hitting new highs, have you heard any employee emails leaked lately? No. So there's always manipulation in the market, and that's really what we help people learn and see in the market every single day. The news that happens is always justifying the move after the fact. So know that CNBC, Fox Business News, all those are great if you want to feel really stressed out about your position. But if you really want to know and break it down, it's pretty simple, right? So we have the dark pool print that happens. Like we've seen all of those ones on Tesla. That one was 379, right? 379, 379.09. So 379, right down here, they started, right? This is all off because of the, I have Camarilla pivots on. So they were consolidating here, and then it ran out even higher up here. And it ran up, right? So we're above. What does that mean? We broke the bullish above level, right? We break it down to be fairly simple, but you really need to understand it and see it day to day to really get the nuances of it. But we have the bullish above level. If it breaks the bullish above, what do? Buy the stock, go long, or buy calls. And you're going to aim for a price target. We break it down with price targets every single day to help people for day trading. And know that if you are swing trading, if you start to see more prints and you're above them, more affirmation that it's going to be going up. And then same thing, if dark pool breaks below, bearish below level, so you're going to sell the stock or go short, or you're going to buy puts. And if you find yourself on the wrong side of that print, what do you think you're going to do? You're going to go ahead and exit the position or be nimble and flip that position. Try to keep that ego out of it and try to stay humble to the market, because otherwise it can and will pummel you if you're not humble to the market. So when these guys have the billions of dollars, wouldn't you want to ride their coattails? There are 4 ways that you can really learn about trading the dark pool. So if you're newer to trading or you really want to reset and really learn about the dark pool, there's the training pit, where I work as a teacher. I'm sorry, I was running a little behind today because I just finished up a teaching session today. And then we also have a self-study with the prints with the Stock Whisperer app, which is great. I really use that when I'm not in front of my desk, because there's so much that's not on there that's all on the computer, and it's kind of like, oh, I wish I had everything, my fingertips. And then there's also, if you really want to get into it, it's actually now 70 hours for the dark pool bootcamp. And the next one is going to be February 10th. So it's always during earnings season, because the earnings season is always going to provide opportunities for people to go ahead and have trades. What is float volume? All right. Did I answer your question about float volume? Short float volume? I just saw the questions there. And then the final one is joining the Java pit. So the Java pit is very advanced. We have our own little language in there. After you've gone through all the other training, you totally understand what we're talking about. And we all work together. We all shout things out to try to be a very positive community to help everybody profit. You know, if somebody has a great trade and somebody else is on the sidelines, it's okay. We have so many opportunities every single day. I think we had 7 different stocks that were on our Whisper today, which is amazing. And we also have not only just stocks, but also futures are thrown in there too, with levels to watch based on what's going on with the stock market, right? Because if we start to see massive prints coming in on the indexes, do you think that's going to influence the futures? Yes, for sure. All right. And I wanted to go ahead and offer to everybody that's watching, that's live right now, 20% discount. I also do my own personal list. This is mine from today. Actually, no, it's not from today, but that was from yesterday. I put it in. And you'll see, like, if there's a low float one, be cautious, but sometimes those can be great, right? If you are one of those more daring traders and you really want to go ahead and trade the low float stocks and you're great at shorting them, hats off to you, right? You can also see if it's an earnings announcement, right? It'd be in bold right here. So you can see, you get a little bit of influence. And I always put the daily short percentage for ones that are going to be, that I think have that potential to continue with the gap up, right? That, hey, let me look at that short volume so that I can see, is this going to be one that's going to have the likelihood to go ahead and gap up? And I also wrote a book because when I was a woman breaking into the day trading world, I didn't see any examples out there that were readily available that I could read about. And much like Market Wizards and Momo traders, I really wanted to give back, and I wanted to read a book about female traders, especially day traders. And so it didn't exist at the time, so I went ahead and wrote it. I actually won 2 awards for it as well, and it's great. It's traders that have experience from 5 months to 25 years and have all made it happen and work for them. As a mom of 2 girls, it is amazing to have the flexibility to not have to go to work, right? You can sit at your desk, you can take a personal day anytime you want. There's no issues whatsoever. You don't have a boss breathing down your neck, and it's great independence. So definitely check that out. And I also would love to invite every one of you to the Modern Trader Summit, which is going to be in Philadelphia this year, July 12th and 13th. The 12th is going to be all presenters presenting their information. And then on the 13th, we're going to do live trading. So I haven't added on that second day. Every time that I have the event, I always ask the attendees what more they would like to see. And everyone has said more interaction and live trading. That's the big thing. People want to experience it live, and they want to be able to practice. So I want to help people the best way that I can. And so doing that for me includes helping with the Modern Trader Summit every year. So I would love to see you there and meet you all in person. And definitely check out the site. It's just themoderntradersummit.com. And if you guys have any more questions or anything else, please feel free. You can email me. This one is updated. It's Airplane Jane. And I'm Miss Airplane Jane on Instagram and YouTube, LinkedIn, and Facebook as well. So feel free to reach out. I'm very happy to help you guys and happy to help see you succeed. Like, there's really nothing better than helping others succeed in this world and giving them the tools to do that. Does anybody have any questions at all? I'm not sure that I can, it's hard for me. Hold on. I see very, very little. Hold on, guys. I can see the questions, but I can't. Hold on. I don't know how old the questions.
I'll just go ahead and
yeah.
cover.
It's like here, okay? it's one line. That's all I can see.
No problem at all. So here, basically, the main question is from Oswald. He's saying, for day trading, what assets do you use and what minimum capital?
As far as assets, I trade both stocks and options. Obviously, like the stocks, typically I will be looking at them $30 or less. And then for options, especially ones that we've had dark pool prints on, it would be the higher price stocks, but specifically ones that have tighter spreads on the option pricing, because you can lose money if you get in and out, and if that were to go against you fairly quickly, like Amazon has big spreads, Tesla. However, if you were to go ahead and trade it as a spread, like a long call spread or put spread, that can minimize the investment cost as well. It will also minimize your overall potential return, but it would be less costly that way to be able to trade to the larger high price stocks.
Got it. Makes sense. So we're running a little bit short on time here today. So I just want to make sure everybody knows the way to reach out or the way to take the next steps here is Anna typed it into the box. It's Jane at thedarkpools.com. And the special for today is 20% off. I want to say thanks, Jane, for being on the show. Again, always great to have you. And I hope you have a great rest of the holiday season and an amazing 2020. Any last words for the guests?
Carpe profit. Seize those profits one trade at a time. And Happy New Year.
Great. Take care. Thanks for being on the show, Jane.
Thank you. Bye-bye.
All right, it's been a great show today. We've got our last guest coming up here, and our last guest is Larry Gaines. Larry trades options and futures and is the founder and CEO of Power Cycle Trading, where he teaches others to generate income from trading using a disciplined, systematic approach through a price cycle trading system he developed based on decades of trading experience. The model is successfully used for options, futures, e-minis, and forex trading, and it capitalizes on achieving higher trading profit margins with smaller capital investments. This same model can also be adapted for swing trading in addition to longer term investing. Larry lives in Texas Hill, in the Texas Hill country with his wife and his yellow lab. Welcome to the show, Larry.
Well, thank you very much for having me here today. So looking forward to it.
For sure, it's great to have you on the show. So we'll do a few minutes here, just chat, and then we'll turn the screen over to you. Okay?
All right.
So let's talk about you and your history a little bit. Currently, you are the CEO and founder of the Power Cycle Trading. And before that, how did you get into the financial markets? How did you get into trading?
Back in the 80s, had gotten out of college and was fortunate enough to get a job interview and a job with a company called Coastal Corporation, which was a pretty big integrated oil company, lots of refining and things like that. So they actually put me through a training program to learn how to trade crude oil. Spent some time down in the refinery. Then they put me into their shipping department, learn about shipping, chartering tankers, cargoes like that. So that's where the whole career started. And then went to out to Asia with Coastal, traded products, fuel oil, jet fuel, all that kind of stuff. And then went to another company called Transworld Oil, which was one of the largest oil trading companies in the world at that time. So worked there for 17 years, ran the trading desk in Bermuda, the international trading desk there for 10 years. And we traded everything, anything from tons of energy. We were one of the largest energy oil trading companies. But we got into all the other asset classes, all the futures markets, bonds, and foreign exchange, and started trading options back in the mid 80s. On oil with Transworld. And so that just kind of started my learning adventure for trading. And so I've been just passionate about directional trading and then using options for risk management and leverage. And just I love options though, primarily because all the different structures and things you can do. And I'll show you kind of my favorite strategies here today.
Very cool. So this year, talk about 2019 since it's about to end. And especially if you really like options, how did the volatility impact your trading in 2019 and what are your expectations for 2020?
Well, the volatility, we had some periods of volatility, but the volatilities pretty much throughout the year were pretty low. For 2020, we'll probably have some higher volatility. There's always going to be uncertainty. We've had a market going, pretty much trending higher for 10 years. So when that starts to stall, we'll see more volatility come in, and that's where the importance of options can really pay off for you, because you can really keep your risk, your defined risk, super, super low, as you'll see here today with some of these strategies. So it really becomes a great way to incorporate options in your trading, especially with higher volatility market. And so I think that if you pay attention here today, you're going to see some things that you can add to your toolbox of trading for 2020, and I think it'll help you tremendously.
Very cool. And so when you say options, are you talking specifically options on stocks or ETFs, but also on futures?
Primarily, I like to deal with stocks and ETFs because it's just more fun. There's just more variety. You can do the same strategies with futures. It doesn't matter. The underlying securities are all offers options as a kind of a derivative to hedge risk. So you can do it with futures, anything basically. But I enjoy the stock side of things or ETFs because they're just such a big variety. So it makes it much more fun and more opportunities. You don't have to be doing the same thing over and over and over, which after a while can get pretty dull.
Got it. And I'll ask one last question here before we go into your presentation. If you can, off the top of your head, what was your best trade and your worst trade of 2019?
Oh, wow. The best trade, God, thinking quickly, TLT, the bond ETF,
Yep.
it had explosive move and we caught that. That was fantastic. Worst trade. Hmm.
I mean, people
You
love
know,
to always hear people talk about their
yeah, I
losers.
can't
So,
really, well, the way that I teach our members and clients to trade is that with the stop loss is really tight. So there's not really a trade that we would have stayed in that was just, super horrible and horrendous that you're just getting agonizing pain each and every day watching it go against you. So it's just not the style of trading that I teach. So I can't really, I mean, there's always going to be some bad trades, but I can't remember one that was so bad that it's just ingrained in my memory bank. Ask me that 10 or 15 years ago, I could tell you a bunch of them, but I've changed that my style quite a bit.
the best educator is pain, right?
Yeah, exactly. You learn from your pain. So that's what I try to pass on, all the painful experiences that I've had in my career. So hopefully you can avoid those same mistakes. And that one of the biggest mistakes is over trading, chasing trades, and not keeping a tight risk management plan if the trade goes against you.
Right. And a lot of people they seem to focus a lot on their winners and get angry or ignore their losers. I mean, would you say that's correct, or do you feel like it should be the opposite?
Oh, absolutely. That because of the pain. So if you can, and that's another reason why to cut your losers, cut them. Don't agonize over. Just don't keep staring at it. Cut the thing loose and go on to the next trade because there's plenty of trades out there. Each and every day you can find something new to trade, especially if you're trading, stocks and ETFs. Futures a little bit different because you're just kind of, uh, you know, captured by that specific market. If you're trading gold futures or oil futures, it can get pretty boring. So that's why, I mean, I'll look at those particular asset classes if they look like they're getting ready to break out or something that you can make a trade with. But that's not just the only thing I'll focus on. I'm just looking across all the different variations of assets to find the best opportunities. And we do that with our trading model. And we've got some scanners that trade for what we call a volatility squeeze, which is a period of consolidation, and then you have a breakout. So I'd like to trade breakouts and reversals and then use options to make those trades.
Got it. Yeah, and so it sounds like your trading methodology, at least now in terms of the risk and the tight stop losses, is very similar to my history in trading. And when doing that, what type of risk reward are you looking for, or is it variable depending on the trade?
Well, what I like to do is kind of when I'm looking at swing trades, those are trades I kind of define as it could be a trade that you get in for one day and out the same day, or it could be a trade that turns into a week or 2 weeks. I like to keep it kind of more short duration, so maybe 1 to 2 weeks at the most to, as far as the length of a trade. And so the kind of risk reward ratio that I kind of like to look at is a risk a dollar to make $1.50 kind of minimum, and then go from there. So with some of these different option strategies, you can risk a dollar and make $10. So you're going to see some examples here today. But I like to kind of first I look at that parameter, risk a dollar to make $1.50, and then or greater. So that's kind of the parameter I look at. Now, if you're strictly selling options, it's a totally different game. It's a game of probability. So you're going to have a negative risk reward. You're going to be risking more than you can make. So, but
Right.
it's a different animal. So my preference is to combine buying options and selling options to get a better positive risk reward ratio to your trading.
Got it. Yep, makes perfect sense. So what I'm going to do now is I'm going to transfer the screen over to you. Yeah, I just enabled you as an organizer, so you should be
Okay.
able to see the questions box on the
Okay.
GoToWebinar control panel. If anybody has questions during the presentation, you can feel free to ask them. And if Larry gets to them, great. If not, at the end of the presentation, Larry and I will chat for a little bit. We'll talk about his program, and I'll follow up with any questions that he may not have been able to get to that were in the chat window. So I'll turn the screen over to you now. Are you ready, Larry?
Yes, I am. Thank you very much.
All right, here we go. I'll stay on and make sure we got the right screen showing.
Okay,
Otherwise, we
let me
might get
get
your other
that.
screen with your Christmas shopping list up.
Yeah, okay. Can you see it now? Yeah, my Christmas
Butterflies.
shop.
Yep.
I actually did a little bit of that yesterday.
All right, cool. Well, take it away, Larry, and then I'll be back in about 30 minutes. Okay.
Okay, well, thank you so much.
Good. Yep.
Well, that was a lot of fun. Thank you very much. And thank everybody here today for showing up and being here. So hopefully I'll show you a few things based on that kind of short interview of the way I like to trade and the different strategies that can really give you some fantastic what I call positive reward to your risk. But these are also strategies that are fantastic for hedging. So, as we get in 2020, we never know what the market's going to give us or bring us, but we're always going to be periods of high uncertainty and volatility. So these are strategies you can use in any market, but especially can pay off for you nicely in real high volatility markets, as you're going to see. So again, a short interview there beforehand. I've been trading for a long time, been trading options for now over 30 years, and started back on the oil side. That's a picture of me back in Bermuda at our trading desk. Spent about 16 years in Bermuda, ran this trading desk for 10. So it was a fantastic experience just from a trading plus a living experience. If you ever get a chance to go to Bermuda, make sure to take that trip over there. You'll like it a lot. So the following webinar is purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So what if you did have a trading strategy that could turn around your losing trades and maybe even turn them into winners? And what if that same strategy could capitalize on the two main option pricing components, which is time decay and volatility collapse, more than any other method? So would this be worth your time to learn it? Now, over my 30 years of trading options, I've found that the most valuable go-to option strategies that can literally help any trader out there more than any other strategies are known as the butterfly and the long condor option spreads. So the huge advantage that these strategies give you are their unique option framework that allows you to construct the trades that will provide more consistent and greater returns in any type of trading environment, and especially a high volatility market due to the simple but dynamic structure they offer. Now, because they are structured to require only a small amount of your hard-earned capital, your trading returns will be a lot greater and your trading stress then becomes a lot less and becomes basically nil. And that's a really major win-win for traders. Now, the butterflies and the long condors are very dynamic and they can be traded for a variety of different reasons with different goals in mind. So in other words, you're going to learn how to trade butterflies and long condors, and you're going to then be covered for both your offense and defense of your trading. So profit and also hedging or defending your trades. So goals and protection. So these types of strategies, they can work no matter what the markets are doing. They can be up, down, or sideways. Can provide income from stocks that are going literally nowhere, eliminates the stress of having to be perfect on a stock's direction or overall market, eliminates the time decay expense that's encountered from if you're just going long options, takes the unsettling guesswork out of your option trading or out of your trading in general, and these can be structured for very, very low cost and low capital at risk. So this can provide you of returns of 10 to 1 or higher. And you'll see a few examples here later on, how powerful these can be for that kind of major positive risk ratio rewards that you can gain. Now, butterflies and the condors are also, they're very flexible, as you're going to see ahead. And once you learn the fundamental setup, you can then adapt these option strategies for both your goals and your market insights. So you can construct it to be kind of more delta neutral, where you don't really have to have that direction perfect. But the real beauty for me is that they can be directional. And trading really comes down to price, direction, timing, and then managing your risk. So these are a great way to trade direction. And so they can offer you then a bullish or bearish exposure to the market when you feel, pretty certain or sure a stock is headed in one way or the other. But if you're wrong, these types of strategies, the butterfly and long condor, can really help you to manage that risk. But at the same time, you can retain a large potential for returns. And that's always a win-win. So if you find a strategy that can keep your potential risk or loss low and small, but still at the same time offer you a huge return, those are the kind that you want to try to follow. Now, but let's be real, these types of option spreads will not offer you that unlimited profit potential, but they're going to usually cost you a lot less than if you're buying outright, calls or puts for direction, and they offer you an amazing risk to reward trade setup. So this means that the butterflies and the long condors will significantly increase the probability of your winning trades while also at the same time reducing your risk. And that's really what it comes down to when you're trading. Now, the butterflies and long condors, they can also be used for hedging. So when you mess up a trade, and it's going to happen, this is a really fast way, low cost way to cover your pronto when a position moves against you. So you can neutralize that trade quickly, you can lower the risk quickly, and then that's going to help you to stay with the trade if you need to, or keep your losses low. And I found that there's no other hedging strategy that comes even close to using these for hedging. So for example, by constructing a butterfly structure or a long condor around a strike that you have on another option trade that's currently under pressure, from a core trade, such as maybe you had a credit spread on starting to go against you, or a debit spread starts to go against you, this becomes one of the best ways I have found to immediately neutralize and control your risk. So for example, you can keep the original position open. You don't have to just stop it out, take a loss immediately. By hedging it, you can keep that position open for a while by implementing either a butterfly or long condor hedge against it or around it. And so this type of hedging strategy, what it does, it's going to take advantage of that major pricing component, time decay. So while you're waiting for that position maybe to stabilize, many times it takes a little time, but as that time moves by, you're taking advantage of that time decay while you wait. And a lot of times that's all you really need, just a little bit more time for your original position to stabilize and then move back in the favor of that direction that you were looking at to go. And at that point, you can remove the hedge, stick with your original trade, write it for what it's worth. Now, here's an example of just the simplicity of these types of spreads. So here's like a call debit spread structure. So here you'd be long a call here, okay, and then short a call. So this is what we call a call debit spread. And so this is a defined risk directional trade, which is good. And in this example, you can see the risk here would be $300. So if everything went wrong and went straight down, you could lose $300 if you didn't adjust it. But if you understand how to use vertical spreads, then we can easily adjust this trade or neutralize this trade to reduce our risk and still stay in it without having to stop out. So what we could do quickly, we could sell a credit spread against it. So we could sell a credit spread here and bring in $2 credit or $200 credit. The combination of that then is we had a $300 debit spread. We added that credit spread to it. So we had a long call here, short call here, and then we added that credit spread by selling another call and buying a call here. All right, so we just went from a $300 max risk on the debit spread. We brought in $200 credit on the credit spread here. So now our risk is only $100. All right, so we just reduced that risk from 300 to 100, and we still have a potential trade that can profit if it goes out within what we call this profit zone of that butterfly. So that's kind of the profit zone. We call it the tent. So that's the beauty of it. You can neutralize and put a trade down risk-wise super fast and still have the potential to stay with it, or then you can do a lot of other adjustments and even leg back out. Now, the long condor is very similar to the butterfly, but the thing that is really nice about this is that you've got a wider profit zone. So instead of selling that butterfly where you're having to really kind of thread the needle here, if you have enough premium, you can widen out the short strikes of your, in this example, say a call credit spread. So you can make a bigger profit zone. So this is a really great way to not only reduce risk, but also provide additional return plus a larger profit zone for that return. All right, so that's basically all that there is to it to do a long condor, and you can do these with puts or calls. Now, the core concept that make these types of strategies really amazing is to understand the most important option factor for profit generation or options in general really comes down to understanding the concept of time, okay? Time and theta and that decay and how that impacts price. So if you're looking at options, you've got the major pricing components, which will be time or theta and then implied volatility. So let's take a look at the time component of a butterfly and the condor, see why this is so important. Now, when we look at time decay or theta tells us how much an option price will go down or diminish over time. So that's the rate of time decay of your stock's option. And time decay occurs because we refer to that time decay as extrinsic value, because time value of the options will go down as expiration draws near and eventually it goes to zero. So it's like a coupon that you might get at a grocery store or whatever. You'll see that coupon, hey, you've got to use this by January 1st or else it's no longer valid. So that's exactly how an option is. So eventually it goes to zero. So you have to understand that big, huge pricing component, which is time. So when we look at the butterflies, then we'll go through these construction of it. But you've got the butterfly and the condor, and these both have a major impact. Time has a major impact on these strategies, and that's what we take advantage of by having that sell side component of this strategy or structure. So here's an example of time. Whoops. Now, let's say we were looking at the company XYZ and it was trading at $45. Now, with a butterfly, this is a butterfly example, you can see how you can get your risk super low. Now, we're targeting this, in this example, $43, so not really a big, huge move down. And that's the other great thing with these types of strategies. You don't have to have huge moves. You can make great returns on small moves and really short duration. So we're just looking for a target move down to 43 directionally, but we want to keep this super low risk. So a butterfly could be done. And in this example, all this is doing is we're buying one contract of the December 44 put. Okay, that would cost $2.38 or $238. And then we're going to sell at the same time. We sell the December 43 put, get $1.67. So here we just bought a put debit spread, 238, sold the D43, and then we're going to sell another D43 and buy the 42 put under it. Okay, so that's creating a put butterfly for a downside kind of target move to 43. So the butterfly gets its name from the body right here where you have those two short options. Okay, so that's the body of the butterfly, and then the wings are what you're long. So in this example, your debit cost here you can see is $2.38 for that 44 put, $1.06 for the 42 put, and then you receive $1.67 two times for selling the 43 put times 100 to convert it to an option contract. So in this example, the maximum risk here is $10. All right, now your potential profit then is just taking that middle strike. If you look at the potential profit here, all we're looking at is taking that middle strike less the lower strike less the cost of your trade, and that's going to give you your potential theoretical profit. So in this example, 43 minus 42, so that's a dollar-wide spread less the cost of the trade, 10 cents equals 90 cents is a potential profit times 100. So theoretically, on this trade, you can make $90 per option spread. Your cost is $10. That's the maximum risk if everything went wrong. And if you look at that, that's a 900% return. Okay, so the 9 to 1. So you risk $1 to make 9. So this is pretty common. You can, in the butterfly, you can control the risk by making it either narrow or wide, but you know what your risk is. And you can structure these things then for, some really great returns. So just think about it. If you had a 9 to 1 potential, but what if you made 50% of that or 40% or 30? It's still a fantastic potential return. Okay, so that's pretty common with the butterfly structure. Now let's take a look at some of the best butterflies and long condor strategies, for your trading goals and for whatever environment you're trading in. So one major goal, in my opinion, of every trader really should be to select trades based on what's going to provide you the most consistent positive returns with low defined risk and not always the greatest return. And one of the best ways to achieve this then is by knowing and being aware of what the option strategies are available to you, understanding how they work, and then selecting the one that's going to be best suited for the market environment you're trading in and your specific trading goals. So everybody here today will have a different amount of trading capital you can trade. Jack might have 10,000 in his account, and Charlie, might have only might have 100,000. So it's going to make a big difference as far as how you trade, and then what the environment you're trading in is. Is it really high volatility, uncertainty, things like that? Now, when we look at the butterfly strategies, I kind of call this a family of the butterflies. We've got long call or put butterflies. You can use calls or puts. We've got what's called a broken wing butterfly. We can use calls or puts. We've got a ninja or ratio butterfly, wide wing butterfly, directional butterfly, iron butterfly. And then you've got a whole nother category of hedging using these butterflies to defend a trade. And then we've got the long condor, which is very similar to the butterfly. So let's take a look at a few examples here so you can get a better feel for how these things can work. Now, first one, we'll just look at a regular balanced butterfly. And what the big advantage of, why would you trade it? Well, these butterflies are structured, as you're going to see, for very low and very defined risk. And you're actually by selling a butterfly or buying a butterfly, basically you're selling time and selling volatility. So this gives you potential for very high return on your capital. So here's an example of a very tight butterfly. This is a very narrow butterfly. You'll see with very, very little risk. So this is a trade set up directionally. You can see it was trading right here about 267 where my pointer is. And we were looking for a move just up here to, I like to use Fibonacci targets and option activity. So we were looking for a move up here to this 618 level right here, about 273, 274. and there was a lot of option activity. So we wanted to keep it very small risk. So the trade setup was just a dollar wide spread. So going long the 272 call, selling the 273 call, then selling that 273 call again, buying the 274. So that creates a butterfly that's very narrow, very low risk, a very narrow type butterfly here. So as you widen or narrow the butterfly, you can control the amount of capital you're putting up in risk. So in this example, you can see the amount of capital put up was 10 cents or $10. So theoretically, if you take this a dollar wide spread, okay, $100 less your cost of that trade of 10, so that's their maximum risk. The theoretical potential profit then is $90, or here's your 900% return, 9 to 1. Now this went out actually 2 days later, making $70 per spread. It didn't make the 90, but it made 70, so that's still an unbelievable return on that small amount of capital. So that's what's really cool about these types of strategies is the structure. You can really define that risk and keep it low. If you want to keep it super low, you can do that. So here's what it looks like. It was going out right here on the profit take on the 16th. It was trading right there at 273, right almost to our target. And so you can see here on, this was 4 contracts, so it went from 10 cents debit to an 80 cents debit. So that's your increase there of $70. And so there's your $70 profit on that risk of 10, so 700% return. And that's taking advantage of time decay going to 0, volatility going to 0, and that's the beauty of the butterfly and also the Condor. So 2 things that we know are going to happen to an option trade is when you go to expiration, the time component of that option will always go to 0 regardless, and volatility goes to 0. And we can take advantage of both of those pricing components when you do a butterfly strategy. So here's another example. Here's a wide wing butterfly or a wider. I mean, you can do these various widths. So here's one just kind of currently, just one that we did last week. And this was setting up a call butterfly on SPY, the ETF. The ETFs are great for these structures because they're very liquid and very, very liquid, and they're just trade directionally very well. So here's a butterfly we set up last week. So it was trading right here at 315. So we're looking for a directional move up to 320. That's a Fibonacci level. And there's a lot of option activity at that 320 strike for tomorrow's expiration. So we targeted that with the butterfly. So what we did was basically bought the 217 call right here, sold the 320. If you look at that, that's a call debit spread. And then at the same time, simultaneously then, sold another 320, bought the 323. So $3 wide spread, and we made a $3 wide butterfly, all right? Now, if you look then theoretically what the profit would be, it's a $3 wide spread, 300 minus the cost here, 85 cents or $85 was the max at risk. So the difference, theoretically, you can make $215 or 252% return. So that's a risk $1 to make 2.52 on that. Now, this was earlier today, was trading right here. This went out, it was trading, I'll show you in a minute, but it was up $147 per spread. So that's on your risk of 85, that's a 173% return. Where can you do that? There's no other really option strategy or strategy period that can give you these types of returns in a very, very short period of time. And this one's 7 days, sometimes it can be less. So here's where it was a little bit earlier today, and it was trading right there, very close to our target, right here to 220. It was actually trading at 320.26. But see all that little black area? If this is there tomorrow, this will have even more profit. Remember, this has potential to make over 200. But that's where it was here earlier today. So it went from an 85 cent or $85 debit, and it was trading at 232. So that's up just one option spread. That's up $147 for one spread, and that's a 173% return. So if you did 10 spreads, you can just see where you'd be, and you're still super low at risk. So that's currently today, and this has more potential for tomorrow if you stay with that trade. All right, so that's a kind of what we call wide wing butterfly. Now here's another example of a wide wing butterfly, and sometimes we refer to these as vacation butterflies because you just can put it on, you know what your risk is, you can get it pretty low, and then you just come back looking for option expiration the day before or the day of option expiration. So sometimes they're referred to as vacation butterfly. And this is another great strategy for playing these big high price stocks like Amazon. So if you see all the activity and options are Amazon moving up and down crazy, but it's too expensive for you to trade with the stocks. Here's an easy way to trade it for very low at risk. So here's the example. So we were looking at Amazon back here in August, and it traded down here to this 200-day moving average, and it was just churning. And we were looking for just a little bit of a move back towards this 1830 level, which was a Fibonacci level right there. So we thought it had a good chance to go back to 1830. So we wanted to construct a trade that wouldn't cost a lot, because it's so, Amazon can be just a beast, and wanted to keep the risk super low as far as capital put up. So did what we called a wide wing butterfly $10 wide spread. So we were targeting that 1830 price right there. So bought the 1820 calls, sold the 1830, and then sold the 1830 again, bought the 1840. So that's $10 wide spread. You can see that. So that's $1,000 for one option contract spread width. Now the cost of this trade then was set up for $80. So you're controlling a stock here at 1830. That's, if you bought 100 shares of that, so that's 183,000. You're controlling basically 100 shares of this for $80, right? Pretty crazy. Now, here's your potential profit. So you've got $1,000 wide, less your cost. So theoretically, this could make $920 on your risk of 80. And look here, that's 11.5 to 1. So theoretically, you risk $1, you can make $11.50. Now, we're never looking to make that, but if you come even close, it's still pretty fantastic. So let's take a look at what this was doing a little bit later. Let me erase this. All right, so here's your potential profit. Now this was going out, it wasn't even close to the target here. So this was on the 6th, early in the day. So this was the spread value on the 6th, and that was in the morning. So this was up $150 right there. See where it was trading? Right there on this is what we call risk profile graph on Thinkorswim Analytics. So this was up $150 right here on one option contract, or butterfly. And so that was in the AM, but look at the difference here in the afternoon. See all that black area in there? That's what's still left, potentially a profit from time decay going to zero on expiration day, which that was, and also volatility. So here it is in the afternoon. Look at the difference here. So this went from $150 profit in the morning, all right? So just staying with the trade rest of the day, went up to $614 right here as it was going out into expiration on that same day. So, look at the difference in the return here, 769% return on $80 just a couple hours later. So that's what we're doing, taking advantage of that time decay going to zero and volatility going to zero when you structure these types of trades that take advantage of selling time and volatility, as well as being long options. Now here's another kind of different twist for the butterfly. This is what we call an unbalanced or ratio butterfly. And here's an example of this structure on QQQ, the ETF. So all the unbalanced or ratio butterfly is, it's just a variation of a regular balanced butterfly, but you're going to add an additional short vertical credit spread to it. So when we're selling vertical credit spreads, you can sell a vertical call credit spread, which is a kind of a short type of trade setup, or you can do it with puts for a directional up move. So if you just add an additional vertical credit spread, you can then increase your potential profit from that and kind of bias the trade to one direction or the other. So then it comes down to being simply two in the money credit spreads protected by a slightly narrower, closer to the money debit spread. So this is going to create a very low defined directional trade for you. And this strategy will alter the risk into one direction and increase your potential reward, but still keep the risk very, very small, depending on how you structure it. So here again is another example. This was QQQ. I put ratio butterfly. We were looking for a move up here to this kind of 165 area right here. So in this particular strategy, we were thinking, okay, if it really broke out, it could go much higher. So we, instead of doing a balanced butterfly, which would potentially could lose money if it kept going higher, we set this up as a ratio butterfly. So we brought in a credit. So this would profit regardless if it kept going higher. So here's the trade structure. So basically this is a put butterfly, ratio butterfly. And at that point in time, QQQ is trading at 160. We're looking for a move to 165 towards expiration. So it's basically, you do this simultaneously, but here's breaking it down so you can see the components. It says this was buying the 166 put, selling the 165. So that's a long put debit spread. So that's kind of a bearish component. And then you're selling at the same time 2 more of the 165 puts and buying 2 of the 164. So there's that ratio 2 to 1. So you're actually skewing this for a more directional move up by selling this bull put credit spread twice and buying just the put debit spread once. So there's your ratio butterfly kind of construction. Now you can see then how cheap these can be depending again on your vertical spread. So here was a dollar, it was 166.65, 64. So it's a dollar wide spread. So that's $100. And this type of structure, you're going to actually do it and get a credit. So if you structure it right, you want to receive a credit. So in this example, received a credit of $57. Now, what that does for you is if this was to still just explode to the upside and it close or trade above 166 at expiration, if you'd done a balanced butterfly, you'd lose money. But this one, you would still make money. You would still keep that credit of $57. Now your risk is 43, so that's still that would be still over 100% return. But if you hit the sweet spot right around 165, you can make close to or up to $157, which would be a 365% return on your risk. Now this went out with $136 on that risk of 43, so 316% return. All right, so it's a really great structure for certain situations, kind of like that one. And so here's what it looked like going out. So it's almost nailed it right into that 165 profit zone right there. So this went from a 57-cent credit, you can see my arrow down here, to a $79 debit. So there's that profit of $136, which is a 316% return on your capital at risk of 43. So another really great way to take advantage of that, volatility and time decay and leverage. Now here's one more example. This is what they call Condor. So here's an example of a long call Condor on Facebook. And very similar to the butterfly, this is going to reduce your risk, keep a positive, really good return. You're going to have a positive theta, so it takes advantage of theta decay, and you're going to get an increase in your return on your capital at risk plus a very defined risk trade. So here's that kind of structure here. So you can do this with calls or puts. In this example, it's a call Condor. So we're looking for a move up, and then we hedged off some of the risk by selling a credit spread against it, but we still have a pretty wide profit zone. So in this example, we were looking at Facebook. It was trading right here about 194.76, and we were targeting up here just to $200. So did this as you can leg into these, or you can do it as the Condor to begin with. So it's a great way to leg into and hedge. So you can see in this example, the max risk, this was going long, the 195 call, selling the 197.5, so call debit spread, and that part of it cost $105. And then the other part of the component of the spread was selling the 200 call, buying the 202.5. So there's a bear call credit spread, we're receiving $30 credit. So your max then risk is 105 less 30. So your max risk on this trade is $75. So if everything went wrong, that's the most you'd lose. But if you got everything right and it goes out between your short strikes, you make $175, and that would be a 233% return. Okay, so that's the typical type of structures you're going to see, anything from 1.5 to higher, like I mentioned a little bit earlier. So here's what it looked like going out. This pretty much nailed it. At expiration, it was going out right between our two short strikes. So you can see we were looking at it to go out between that 197.5 and 200. And it didn't have to go out exactly there, but this one did. And so that went from the call debit spread side, made $144, kept the credit spread of 30. So there's your profit of 174. So 174 on that risk of 75. So there's your nice 232% return. Now, if this didn't work out and it traded down here, you'd still make money. Or if it traded all the way out here or down there, your max risk is 75. So, the question earlier was a great one. Do you remember the worst trade that you ever did? I mean, there are always going to be some losing trades, but they're not going to be huge losers where you're going to be just like, dadgum, why did I do that trade? So that's the beauty of using options in general. Now, if you'd like to learn more on how to, really actually master these kind of high reward, low risk strategies using options, and these will work in any market environment, especially you're going to like this when you're getting into high volatility, I've got a super great deal for you guys and gals today. So this is for today only. This is my Butterfly Long Condor Options Masters course that I did back this October. And this course, if you go to my website, you'll see this course here is $397, but I'm going to give it to everybody here as a Christmas special for $97. So butterflies, long condors, this was done in October. If you'd like to do this today, it'd be well worth your while. You're going to get a fantastic course that's on my site at $397. I just thought I'd give it to you at a blowout low price of $97. It's a 7-hour plus course broken down in 30-minute modules or less. You'll get all that plus the PowerPoint with all the details of my courses are very detailed. So you're going to get 7+ hours. This is yours forever. Broken down in modules, the 368-page training manual. Here's the link. Use this link here. And this will be available for today. Oh, where did it go? Hold on. I thought I had it in here. 1 second. Use this. It's powercycletrading.com/BFLY, like butterflies. So here's the link. And you'll get, this is yours, forever. You'll have a vault and everything. So that, let me just double check that link. Yeah, perfect. So all you have to do is click on that, pulls up this drop down, no promo code needed, credit card or PayPal. Now, not only are you going to get this course, but I'm going to give you some other great bonuses as well. But you need to take advantage of this today if you'd like. So this is my step-by-step blueprint course on the butterflies and condors. So it's a very extensive course. Teaches you how to use these for income, high reward, low risk, directional trades, non-directional, and hedging and more. So a lot of this is on how to use these structures for hedging. So you're going to get the 7-hour plus recorded on-demand course. Like I said, the $397 on my site. You'll also then get 1 live follow-up Q&A. We'll send you out a link there and an email to when that will be. You're going to also get my option trading tutorial, which is excellent. My complete option strategy manifesto is another bonus. My Greek power tool guide bonus. And for anybody that's never been a member, you're going to get 30-day trial membership to my trading club, which we have a virtual trading room and all kinds of good stuff. So today only $97. Use that link. Now, part 1 of the course is going to be a review of the Greeks that are important to these types of structures. So theta decay, the impact that it has, and also volatility crush, how that impacts the butterfly and long condor, and then how option pricing, the effects of time and volatility. So you're going to learn all about that. That will be things that you can use for any of your option trading. Then part 2, we're going to go into the core basics that many traders they don't even understand and know about butterflies and what you're missing. But what are the core basics that make these things work? And then we're going to go through the butterfly long condor spread foundation, which are vertical option spreads, okay? How to mix and match the vertical spreads to create these structures. Then how, why, and when to use the long call or put butterfly, that broken wing butterfly, ratio butterfly, broken wing butterfly, wide wing directional butterflies, iron butterfly, long condor. So it's like Bubba Gump, shrimp, but this is some of the different structures, and this will go through when and how and why to use those specifics, okay? And then part 2, the optimal time frames, how far out in time do you go, what stocks and ETFs you can use, index options like SPX, RUT, futures. I mean, you can do these with any structure, any underlying security. And then how do you get that structure where you get that 10-to-1 or higher? So, you'll see and learn how to do that in the course, how to profit from the option volatility collapse, theta decay, two big components of these strategies. And then when's the best time to utilize the long condor for low risk hedge trade, directional trade? So a lot of times I like to hedge, converting a spread into either a long condor or a butterfly. So you'll learn that, when to do it and how to do it in the course. And then another fun thing is how to use these types of structures for what we call a monthly option expiration. So we're currently having monthly option expiration right this week. Tomorrow's monthly option expiration. So we set up a lot of butterflies this week on various ETFs and stocks for what we call pinning. So this is another thing that you can do 12 times a year. You'll learn how to do that. And then how to pick your targets based on Fibonacci is part of the course, Fibonacci areas and option activity. Step 3 or part 3 is a step-by-step checklist, for putting the trades on, taking them off, execution and management of the trades. And then a big part of this course and a big thing that you really need to understand is how to hedge risk. And so you're going to learn in this course how to quickly neutralize your risk, hedge your risk on anything you're trading using either the butterfly or long condor hedge strategy. So you'll get a resource library of what happens for assignment risk, expiration risk, auto exercise, and then you get a trading library of 58 trades that you can go back over and look at to see how these things work. So course is very visual, in your questions in this course, and you'll have a follow-up Q&A. So just a little feedback. Just when I thought I had it all about what I could learn about options, in walks Larry with both guns blazing. Amazing, Jim. Excellent class, Larry, as usual. You're under promise and over deliver. Wish I'd known how to do this hedging before I lost so much money doing credit spreads. How many people have lost money on credit spreads? Well, take this course and you'll learn a lot about how to defend a credit spread and not lose a lot of money. Thanks again for showing so many ways of getting out of trouble. Could have come in handy in the past, and my trading P&L would have been a totally different story, Jim. Aha trading moment, Raj. So you're going to get a follow-up Q&A live. You can send in a question by email if you want. So that'll be part of your bonus option trading tutorial. Comes with this 60-page option guide with videos on the Greeks, option pricing, standard deviation, and more. Bonus 3, my 15 option strategy guide. So you get this, goes through what are back ratio spreads, calendar spreads, diagonals, long straddles. So a nice guide of 15 strategies there. And let me hang up on this guy. Sorry about that. And then you're going to get my Greek power tool guide. So this is, you can put on your desk to show you, okay, what is delta, what is gamma, theta, and then you get a trial month membership. And you can start this whenever you want. If you're going to be away for Christmas or whatever, the holidays, you can start it next month. Just let us have an email when you want to start it. So you have access to my virtual trading room each week or each day during the week, 9:30 to 10:30. Then I'm back for the close. We do a Q&A every week on Tuesday. You get that. Everything's archived and recorded, Traders Educational Vault, and you get 60% discounts on everything I have on my course, all my software and trading courses. So it's a lot and it's a great deal. So hopefully you guys and gals will take advantage of it. So just let me put that link in there one more time, but this will be available just today, and then it's going to go back to that $397 price. So let me see if there are any questions. So that's really it. Yeah, great offer. Yeah, it works on futures. I mean, look, you have whatever you trade, if it's a big security, you're going to have options, and these strategies work on any type of underlying security. So it could be crude oil futures, it could be golds. You can do butterflies on gold, you can do butterflies on crude. Actually, one of the first big, huge butterfly trades got me interested in it. I had set up an over-the-counter option brokerage desk for this company, PVM Oil London. They're the largest privately owned oil brokerage company in the world. And we did a huge butterfly structure for this big hedge fund, 25,000 contract butterflies on oil. So you can do it on big, huge accounts or small accounts, and that's what really makes it very powerful. Question, what's the difference between selling an iron condor and a long condor? Good question. That's a really good question. Let me see if I can show you just a quick example. The structure looks the same, but it's a totally different animal. So if I can just find a little piece of white page here. Hold on. Oh yeah, and some of the other, like for example, here's some of the butterflies. Here's that SPY butterfly, and then I'll show you that. So here's currently the SPY butterfly. We did this last week. You can see it's up right here, 128. Now, if this is trading tomorrow on the 20th, just one more day, look, it'll be up even more. So tomorrow, this will be up, if this will be up here to the top of the zone tomorrow, this will be up close to $200. So this is a butterfly that we set up in the trading room this last week, and then that was on SPY, and then we also did the same for QQQ. So butterfly there, and that's for the monthly expiration. So did that on QQQ, and that's just pretty much really nailing it currently. So we set that one up as well at the same time last week, and that was at 82 cents, currently at 186, so it's up over $100 there. We did another butterfly setup here earlier this week for Disney, targeting down to 145. And so here's Disney. So set this butterfly up, targeting 145. And in this course, you'll see why, how do you set up targets and why do you set up targets, etc. So this is another one that was set up here. And this one, look how low the risk is here. This was set up for $32, 32 cents, okay? And this is currently up, $50 per spread. So if you did one spread, your risk was 30, you're up 52, and there's still a day left. So that was on Disney. And then we did so these are a lot of different types of things that we do at Power Cycle Trading, but pretty much everything is going to be based on options. And I have alert service. Yeah, question is, what is your program for trade alerts? I have an alert service that you can also sign up for, and this is an alert service that's for 13 months. You get everything in our trading club. So you would, for 13 months, if you did that, you'll get the virtual trading room for 13 months, or daily market videos, Q&As. You'll get all that plus my 3 option alert services for 13 months, which would be breakout trades, butterflies and condors, and calendar diagonal spreads. So let me see. So if you're looking at wanting to, learn a lot of great option strategies, then here's a great place for you to get into it. And you're only spending $97. So, if it's something that doesn't work, you don't feel like you've wasted your money, hopefully. So the difference, real quick, before I have to sign off, is when we look at an iron condor versus a long call condor or put condor, they look the same when you look at the risk profile structure, but they're totally different. So let me see if I can quickly explain the difference. So most people have heard about iron condor. So all an iron condor is 2 credit spreads. You sell a call, bear call credit spread, okay? And at the same time, you're selling a bull put credit spread. So it's 2 credit spreads. And the max profit would be just the credit you receive. So let's say you got $50 for the put credit spread, you got $50 for the call credit spread. So you can make $100. But these are going to be always a negative, usually negative risk reward. So you're going to end up, usually in this example, you might end up, the spread width would be maybe $200 and you get a credit of 100. So you're going to have you're going to be potentially, let's say you risk 100 to make 100, or you might be risking 200 to make 100. So negative risk ratio. Now, the long condor, you can do puts or calls, but if you do the long condor, it looks the same, but it's different. So you'd be long a call, short a call, and instead of being short a put, long a put, here you're going to be short another call, long a call. So you've got this potential call debit spread. If it goes out in here, you make max profit. And if it goes out inside your call credit spread, you keep that profit. So this is always going to be a positive risk reward. So you might risk $1 and make $2. So that's really the difference. What kind of option account? You can have a very small option account, because if you look back just at these examples, think about this. Here's a trade. Here's a trade, you risk $75 for one contract. So you think about it, back into that, how much of an account would you have to have? Here you're risking $43. So if you do, you could start out small, do one contract. This is a great way to take a small account and turn it into a big account. Or if you have a big account, turn it into a bigger account. So, I mean, here, theoretically, look at this. I mean, there's a butterfly here that literally cost you $10. All right, so you don't have to have a huge, big account to do these types of strategies. Yes, they can be done in IRA because you're not naked. You're not naked short anything. So yes, these can be done in an IRA. So it's a great thing for an IRA. So it's my favorite strategy probably overall is the butterfly. They're just so versatile. And so here's everything you get. And then, but we do other types of strategies as well, but these are just such a versatile strategy. A level, well, you should be able to do it right away, because these are going to be strategies where you're going to be long and you're not going to be naked short anything. All right. So if you want to find out and learn more about it, here's the perfect opportunity, $97 to get a 7+ hour course on option, butterfly, and condor. So if it's something that you think, well, no, I can't do this, it's not going to be worth it, well, you're out of $97. And these courses, they're very detailed and very, very good courses. All right.
Yeah, I'll just jump in here now, Larry. That's a great
Thank you very
presentation.
much.
Obviously, a lot of questions here. A lot of people interested in getting more details how it works. I'll agree with you on the 97. I mean, these days in trading, $97 is like if you're not willing to try something that you think looks good for 97, then you're probably in the wrong field.
Yeah,
That's the regular life equivalent of buying a cup of coffee at Starbucks, basically.
I know. You can't even
Especially
go
when
to
you're talking about a
Yeah,
month, right?
exactly. So hopefully this is a good Christmas gift for everybody, and your wife or your spouse won't be kicking. You spent what? $97? Okay, that's okay.
Right. Totally reasonable. Totally
Yeah.
reasonable. Well, I think it's great. I mean, I looked at when you're looking at all these bonuses and everything you're throwing in, and the specials only today. I mean, it looks like an absolute no-brainer to me. I think anybody, if you're not sure where the link was or you didn't weren't able to type it in, you can just look here. Anna's posted it in the chat, and it's just powercycletrading.com/BFLY butterfly. So you can just click the link right from the chat window here at the GoToWebinar control panel, which will take you to the page. The page is just basically the $97 cart, $97 cart, so you can check out. But everything that you receive is right here on the page. So considering that you're getting 7 hours of recording, a 368-page training manual, all the other stuff that's added into it, I mean, I think 97 is a no-brainer. I think it's a great deal, Larry, and I really want to appreciate you offering it to everybody here today.
Well, thanks so much for having me here, and everybody have a wonderful holiday.
For sure. You too as well. Have a great rest of the year, and I hope you have an amazingly prosperous next year, and hope to have you on the show again soon.
Well, thank you very much.
Thanks,
Bye.
Larry. Take care. Bye-bye. All right, so that concludes our show for today. I want to thank everybody for attending. Especially want to say thanks to Anna, our producer, who runs everything and makes all these webinars go smoothly and look amazing. We thank everybody for attending today. We're looking forward to having you on the next show. Don't forget to follow us on Instagram. It's all one word, InvestorExpos. It's a great way you can see who the next speakers are and when the next dates are for the next events. And we are taking the week off for the Christmas week season. And we will see you back here on January 3rd. That'll be our next event. I hope everybody has a safe and enjoyable holiday season. On behalf of Anna and myself, Jack, we want to thank you for taking part in our InvestorExpos process and all of our events throughout the 2019 year. We look forward to another great year with you in 2020, and have a safe and prosperous new year.